We have all of the three world's biggest economies suffering from these shocks at the same time.
We also run the risk of a second repricing lower if we see demand destruction roll back.
We could see prices peak back up as we move into the third quarter, really complicating the picture for the Fed.
I just wonder in July whether the Fed will have the stomach, after three good inflation reports as well, to do another 50.
The story here is pretty clear. The Fed's been way behind the curve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here's the bounce. Will it stick? From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up 0.8% TK after the pain of yesterday.
Well, the pain of yesterday and the pain, frankly, of 2022. You know, as we mentioned there, Eric Friedman at the top. John, you're looking for the hope and prayer of gloom destruction. Maybe we have it this morning with a modest lift, a better tape.
HSBC not buying it, Tom. Their view, firmly risk off. They think the growth scare is coming, not in 2023. It's coming in the next 3 to 6 months.
I got a bunch of notes yesterday, John, tearing the strategists and people apart. You know, it's Keynes. When the facts change, I change. And that's what's going on right now. People are recalibrating, readjusting. I would suggest the first step, John, is to wait for the catharsis. And a lot of people saying we really haven't seen the agony yet.
You know what? I've been surprised, Tom, by how few on the south side have actually adjusted. Lisa, Marko Kolanovic over at JP Morgan putting out the note right on cue. We stay pro-risk with overweights in equities and commodities and underweights in bonds and cash. Been wrong over the last few months.
Can you really be surprised about Marko Kolanovic coming out as a bull? I'm sorry. I mean, he's sort of a separate category of Wall Street bull, and he's going to come out and reaffirm what angle you're going to take with respect to what you double down. The story is becoming more nuanced, and I think Goldman Sachs is really, Dan Kostin came out yesterday, David Kostin, and said basically, even if you do get some avoidance of a recession, you're still going to get a downside in stocks. That seems to be the main consensus right now on Wall Street.
Actually, I would have expected at some point a bit of a mea culpa here from the south side, Lisa. Marko Kolanovic has come out week after week after week saying, buy this, buy this, buy this. And this has been months now. This has been pretty relentless. It's not new.
The earnings have been good. The fundamentals still look good. How can they say we're going to change our tune based on belief when nothing in actuality has changed? It is a belief that has changed, not necessarily something that people are seeing in the data. Yes, some people point to waning consumer spending on an inflation-adjusted basis. But if you look at the earnings, John, yes, there's some deceleration.
You sound almost bullish.
Well, it's not bullish, but it's just the reason why there is still so much disagreement and why some people are saying we don't understand what all the fear is about.
So, John, what's going on here is the hope and prayer of gloom destruction. And that we're out there with research notes and trying to put together, you know, forget about demand destruction. We're looking at surveillance gloom destruction here this morning. And, John, I go, look at the results. Look at the tape. I look back 40, 50 years. The drawdown, John, is really not all that bad. If we had a couple harsh weeks, it's been harsh. But, John, I'm sorry. It's not gloom. It's not catharsis.
Don't try and paint me as the gloomy one. This is what I'm trying to say.
John,
this is what I'm trying to say.
What's profound here is that Prince Charles, sitting in for the Queen, has to mention the market. He's got to put a bottom in.
I doubt it. Okay. But let me finish the thought.
Please.
It's easy for the South side to keep saying we're overweight. The tape is doing the talking for us right now. The S&P's down 16% year to date. The Nasdaq 100 is down 26% year to date. Bonds have been absolutely battered. People with actual money in the market are losing out, Tom. So when I sit here and I see the South side keep saying, we're still overweight, we're pro-risk.
Well,
TK, what good is that over the last 5 months? It's meaningless.
I'm going to dramatically skew your good thought there, John, to the bond market. Our guest coming up here has terrific scope and scale. Yield up, guess what? Price down, and the price down in bonds is jaw-dropping.
Let's whip through this price action. Your equity market does bounce back by 0.8% on the S&P, on the Nasdaq 100, up by 1.3. Into the bond market, yields lower lower by 3 basis points to about 3%. And that was the story yesterday for me, this turnaround in yields, not just on 10s, but Lisa, also on the front end, 2-year yields coming in by a big amount.
I was just going to say the same thing. To me, that was a story also. For the first time in a long time, bonds and stocks did not sell off in tandem. There was a bit of flight to safety to bonds. Does that tell you we're at the beginning of capitulation, or does that tell you we're in the next leg downward because people are concerned about that growth that we've been talking about so much? We'll be watching that throughout the day. Here's what I'm watching. 9:45 a.m. Treasury Secretary Janet Yellen is testifying in front of a Senate panel called the Financial Stability Oversight Council Annual Report to Congress. This is going to be fascinating, especially ahead of that presidential speech later this morning, because there has been reports from Bloomberg that, frankly, her staff, as well as Janet Yellen herself, have taken issue with the characterizations of being overly rosy from the White House with respect to transitory inflation or how much it could roll over ahead of the midterm elections. Today, we get a whole slew of Fed speak. Cleveland Fed President Loretta Mester among them, speaking with Bloomberg's Michael McKee coming up today at 11 a.m. Others include John Williams, Tom Barkin, Neil Kashkari, Raphael Bostic, and Fed Governor Chris Waller. What are they going to say? John, are we spending too much time talking about the Fed when, frankly, at this point, it's kind of out of their hands? It really comes down to geopolitical events. It comes to some of the global growth picture, and not so much what they can say about a 50 or 75 basis point rate hike or not. And 11:30 a.m., we do get those President Biden remarks on inflation. It comes today after we get gas prices climbing to the highest levels on record, according to the latest reports. Basically, this goes to the whole Javier Blas point, John, that even if we do get a decline in oil prices, it won't necessarily translate to a decline in gas prices because of the cost of refineries and because of the cost of some of the other processing methodologies.
That's going to be a tough speech a little bit later. Bramo, thank you. Thank you very much. TK, you follow that so closely. The price of the pumps, it's getting harder, not easier.
As we just mentioned with Matt Miller, John, diesel. This is not something most of our listeners and viewers look at, but the diesel leap is factors worse than gasoline. That's a huge deal worldwide, John, and particularly in Europe.
Linda Dussel joins us right now, the senior equity strategist at Federated Hermes. Linda, your line, take a breath. The news on earnings and the economy is good. Markets don't care. Can you build on that for us?
Yeah, no, the markets don't care because they're just all focused on this one thing. The Fed is going to raise interest rates. Inflation is going to run away. But what we forget is that the economy is still in really, really good shape. We're booming. You know, I was there in the 1970s when we had stagflation. You have inflation and you have people losing their jobs. We just had a very strong jobs report. We know that there are twice as many job openings as there are people to fill those jobs. So yes, we think we're going to have a persistent inflation problem versus what we've been accustomed to for 40 years. But now we're seeing some of the baby being thrown out with the bathwater.
Linda, you've got a terrific scope and scale. We had an academic out on the West Coast this weekend framing bonds back to 1841 or 1842. You take the 10-year yield back to 1788. That was the year, folks, when the British landed in Sydney Harbor in Australia. And also there was something there about Mozart completing the Symphony No. 40. How did the 10-year yield now get back to August 1788?
Well, that's really cool because, you know, the bond yield in and around 3% historically is not a high figure. And it's just something that is confusing to me is that we start with the Fed funds at 0, which was unusually low for a long period of time. And we in our business are having angst about 50 basis point hikes. And oh my gosh, what if they do a 75 basis point hike? If we at Federated Hermes think they're going to reach maybe 3.25, maybe the 10-year, 3.25 by this year. And that's not a terribly high figure, actually, historically, but it's just higher than what we've seen before. And so the economy can continue to do really quite well, I think, even as interest rates rise, but just from very extremely, inordinately low levels.
So, Linda, when will stocks care about the economy doing so well?
Well, I think that I think we really have to flush out, and I'm really kind of disturbed about what I've been reading, particularly after yesterday's close when we saw big declines, 10% declines in some of the historical darlings of this market, but also the commodities and now the energy patch. We're starting to see some forms of capitulation out there. where I've been reading a lot of Wall Street people talking about, yes, that's good, but the VIX hasn't gotten high enough. It's maybe 34 on the VIX. We need it to go up to 40 to be totally flushed out. With the sort of damage that's been done, we're so far into the 200-day moving average. That's sort of an idea. We need much more of a hit than what we have had. But if everybody's saying that, I have to wonder if we're going to get that. And if maybe what we should be doing is looking at our shopping list and buying some things, particularly the energy patch, which if you look back 15 years is still the least expensive on a relative PE basis of any of the sectors. And if we just get one inkling that they're opening up over in China, the second largest economy in the whole wide world, then energy prices could start going back up again. So maybe we're having some capitulation in parts of the markets as we speak.
Linda, wonderful to catch up with you to get your perspective. Linda Dussel there of Federated Hermes. Linda mentioned energy. Energy on the S&P 500 yesterday was down 8.3%. One session, that industry group down 8.3%. You take the move in energy, look at the move in the front end of the yield curve, yields lower. Look at the move in break-evens, they actually came down too. Lisa, that's what a growth scare looks like. That's what yesterday was in many ways.
Which challenges a lot of the idea that this really is rates driven, right? That this is going to be something that the Fed is going to hike into, because especially at the front end, the idea that those came down in the day, that basically is suggesting that you're going to get some sort of capitulation from the Fed. I also think it's interesting to note, I know that you saw this as well, Kit Jukes of Societe Generale coming out, talking about credit spreads. They widened substantially yesterday. This is what people have been waiting for. We saw that yesterday finally. Are we getting those credit fears starting to build in the face of growth concerns?
The words of Kit this morning, Tom, that particular canary is just warming up its vocal cords.
Yeah, well, we're there. And I think, John, it's a real disservice for us to game out what's going to happen next, other than, as you mentioned at the top of the hour, there's a modest inflation report tomorrow, which may adjust perceptions.
I'm not even going to pretend that I have tomorrow's prices, because I really do not. And nobody does. Futures up 0.8% on the S&P. The Nasdaq 100 up by 1.3. From New York, we'll catch up with David Stubbs at JP Morgan a little bit later in the next hour. Looking forward to that. For our audience worldwide on TV and radio, it's another beautiful one in New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has signed into law a measure designed to make it easier for the U.S. to send weapons and supplies to Ukraine. The legislation cuts red tape but does not include additional funding. The president has asked Congress for $33 billion in aid to the Ukrainians. Sanctions and Russian oil will be high on the agenda today when Italy's Prime Minister Mario Draghi meets with President Biden at the White House. Draghi resolutely backs sanctions despite his country's reliance on Russian energy. He's also backed sending heavy weapons to Ukraine, even though large parts of his ruling coalition object. And in the Philippines, Ferdinando and Marcos Jr. has brought his family back to power 36 years after his dictator father fled the country. With almost all of the returns in the presidential race counted, Marcos won about 59% of the vote. His running mate is Sara Duterte, the daughter of outgoing President Rodrigo Duterte. And just in time before the summer driving season, U.S. retail gasoline and diesel prices have set a record according to AAA. Average gasoline prices have hit $4.33 a gallon, while diesel is at $5.50. Americans are expected to drive more this summer than in 2021, despite those pricier gas. It's the most expensive American artwork ever to sell at auction on Monday night. A silkscreen of Marilyn Monroe by Andy Warhol sold at Christie's in New York for $195 million. The winning bidder was art dealer Larry Gagosian. Dealers often buy on behalf of clients who would like to remain anonymous. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Basis points over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively. I think we can stay at this pace and this cadence and really see how the markets evolve.
Great to see Mike McKee catch up with Raphael Bostic, the Atlanta Fed president. From New York City, equity futures bouncing back a little bit, up 0.8% on the S&P. On the Nasdaq 100, we advance as well by 1.3. Yields a little bit lower again by 3 basis points. Intraday yesterday through 320. And now looking to break 3 to the downside. This gets a little bit more interesting as the days roll on. Looking forward, Lisa went through this a little bit earlier. I think it's worth going through again. Williams of the New York Fed speaking at 7:40 Eastern. We'll hear from Barkin, Waller, Mester, Bostic again, Kashkari. TK, there's a lot lined up. Who blinks first? That's what I'm looking for. Who blinks first?
This is not a small
on this
idea.
Federal Reserve?
This is not a small idea to discuss this morning, John. There's an assumption this cuts both ways. They let it run into some real damage, or as you say, how do they message this? I don't have a good answer for that, but I think if the radar's up. I'm not looking for a Kashkari-like person to do that.
Sure.
I think it's got to come from the chairman, or maybe even from Secretary Yellen with her experience.
Overwhelmingly, Tom, the consensus is they don't blink. The Fed put is retired, that it's 50 basis points at the next meeting, consider 50 basis points after that. But financial conditions right now are doing a lot of heavy lifting. And I know a lot of people push back against this, but we've seen it before. The test of the Fed, I think it's building already.
We will see. The test of the Fed is front and center. And again, with those inflation reports tomorrow, we're on top of that for you this week with all the research of global Wall Street. Right now, on top of it in Washington with his show, Sound On, Joe Matthew joins. Thrilled to get him up here in the early morning. Joe, you know what I do. I do my research, and I go to the font of what matters nationally, and that is the great benchmark of the 16-ounce strip steak at Burns Steakhouse in Tampa, Florida, checking in at a new $59. You wonder when that goes to $65 or $69 itself. The president's going to address a 16-ounce strip steak at Burns, except it's not funny. For most of America, they've been priced out of beef.
Well, that's true. So you better not overcook that thing. But this speech that we're anticipating from the president today, this whole conversation, this is getting to be very difficult. It reminds me of the scene from Rocky III when they asked Clubber Lang his prediction for the fight. Clubber Lang, a.k.a. Mr. T, answered with only one word: pain. And that is where we are in the world here. The president knows this. His job is to say that he feels your pain. And today, he's going to speak not unlike he did last week. We got a bit of a preview here as the president starts to bear down on inflation. Right. And this is not new. We've been talking about it for 9 months or so. But it's not just cataloging, Tom, what this administration has done, albeit it hasn't made a huge amount of difference. But playing the contrast, playing it against what he calls the ultra MAGA agenda that has been proposed by Republican Senator Rick Scott. He's not even the leader of the Senate, but this is who the White House has decided to choose as a foil. And he will be up there today, and this is going to be the refrain for the next 6 months, playing these two alternatives together. You know, Joe, you're too young to remember this. You were down at Happy Hour at Brothers 4, Casino by the Sea. I can't remember which one you were at. Some of us actually lived whip inflation now. Are we going to get a silly program from this administration? I'm not so sure. I think this is going to be a contrast play and also a call on Congress to start passing programs that you and I have been talking about for the better part of a year. He's going to say, look, prescription drug prices, extended child tax credit, right? A lot of the stuff that was in the Build Back Better plan, he's going to say, I'm waiting for Congress to pass these items to help lower prices. But of course, Republicans will tell you that it's those very programs that will actually amplify inflation. And so this logjam with 6 months to voting is not likely to break anytime soon. Democrats are playing with the idea of a reconciliation bill again, but boy, things are a lot different than they were at the beginning of last summer.
Joe, there was a story on the Bloomberg this morning that caught my attention about inflation being so bad that Democrats want to see the president do more ahead of the midterms. And in it, it talked about Janet Yellen, the Treasury Secretary, and her staff actually distancing themselves from the White House and what they view as an overly optimistic view of how much inflation will come down and how quickly. What do you make of that, the dissent within the White House?
I'm not sure. I've talked with two members of the president's Council of Economic Advisors over the last week. As soon as you get to the second question, I know you're going to talk with Cecilia Rouse this morning, things get to be pretty real. Whether you're talking with Heather Boucher or Jared Bernstein, they know what's going on here. And granted, it's part of their job to project a better day that's coming. But I do think there's a sense of reality at the White House. It's just difficult as they attempt to not talk down the economy. It's difficult to really get a sense of where we're going here. They are still convinced that COVID demand, the shift from services to goods, combined with supply chain problems, are the primary drivers of inflation, and they like to defer the rest to the Federal Reserve. If you're Janet Yellen, I guess you pick your own spot here.
Well, Joe, there's also the issue of gas prices and the fact that this administration has come under a lot of fire for not supporting the fossil fuels industry more and just doing an about-face dramatically and saying, look, this is a national security crisis. Is there any shift within the White House on that front, or are they going to try to message it as all being just part of this equation as we transfer to a greener sort of a fossil fuel-free future?
That's a great question. We're going to hear more about renewables today when the president speaks. This was also part of Build Back Better, right? That we start transitioning away from fossil fuels. The administration, though, has run into a lot of issues after not making a lot of friends in the oil patch and encouraging them to drill more as sort of a patriotic move. There have been more questions about whether they should have financial incentives to do so, actually, having been, felt like they've been demonized by this administration. Tom made the comparison, and I think it's appropriate, to protein as well. As the White House takes a look at this, starts talking about the cost of beef, the cost of protein, chicken, and other food here as a side effects of consolidation, pointing out the big four, that this is the heavy hand of the big four meat packers and producers here, as opposed to taking another route here, maybe finding new ways to unlock independent processing and relate with people on what is a painful experience at the grocery store.
Joe Matthew, wonderful to catch up with you, buddy. As always, looking forward to the program later. Sound on Bloomberg Radio, weekdays at 5 p.m. Eastern Time. The ultra mega plan, Tom, the pushback from the president coming at 11:30 Eastern.
Trial balloon? It sounds to me like a trial balloon.
Feels
as we heat
that
up,
way.
get out the calendar. It's May, John. Where we were 6 months to the election, I think the trial balloons are going to come fast and furious.
The Putin hike was a trial balloon, Tom. Do you think that's resonated at all?
No,
with a lot of people? I don't think that's worked either.
No, I don't think it's worked either. I should point out Greg Valliere with a very emotional note this morning on a very fragile Mr. Putin yesterday in Moscow. I thought Valliere was just especially sharp this morning.
We've got some price action to work through. Yesterday was brutal. Once again, today a bit of a bounce back, up 0.9% on the S&P. On the Nasdaq 100, up by 1.44%. Some really interesting moves in the bond market in the last 24 hours, and we'll break them down next. Yields lower by a couple of basis points to about 3% on a 10-year. Live from New York City this morning. Good morning for our audience worldwide on TV and radio after 3 days of losses. We've got a bit of a bounce here. Will it stick? Up 0.9% on the S&P, on the Nasdaq 100 up by 1.4. If you just break down the moves of yesterday, I think it's really interesting to talk about things that aren't just related to tech. Let's talk about energy. The big mover of the year, the big winner of the year, was the big loser of yesterday, down by more than 8 percentage points on that industry group on the S&P 500. Tech down about 4 percentage points. But there was a real growth scare feel to some of the equity market price action, and not just in stocks, in bonds as well. Want to look at the yield curve, 2s, 10s and 30s, but look at 2s just a little bit more. Last Wednesday, highs of the year, 285. Right now, 259.60. Yields down by more than 10 basis points at the front end yesterday. And Bramo, I think that tells you something about the distinction we've got to draw between the price action recently, yields higher, bonds down, equities down, and what we saw in the last 24 hours. For the first time, a real hint that maybe the market backed away from the Fed just a little bit and inflation expectations came down too.
That's perhaps why you're getting a little bit of a buy the dip today. And I'll tell you why, because some people were saying that when you saw this kind of price action, when you saw bonds actually respond to this buy the dip mentality, and frankly, when you respond to this growth scare, that actually that might be the sign that we're starting starting to get some more of a washout.
Will it carry on, Tom? Just the first couple of signs and worth keeping an eye on. I think it's notable. Your 10-year yield down another 2 basis points today at just about 3%.
The data's there and the data dependency's there, John, and we're going to get a dose of that tomorrow. But I would suggest that yesterday framed out July 27. And July 27 is a new date to really, really focus on here.
The next Fed meeting after the next Fed meeting, Tom.
The next Fed meeting, what? They're not going to raise 50? They got to raise 50. They got a plan. But then what? And there was a massive then what to the feel of the tape yesterday.
That's why I'm still looking at the Fed speak. I'm not sure everybody's fully capitulated on the idea that the Fed's not going to step in when things get bad. They think the Fed put's been retired, but we're about to find out what brings that Fed put out of retirement. Is it this? Perhaps not. Look out for the Fed speak today. Is it more? Well, we'll keep testing things and find out.
We're going to look at the litmus paper, the system right now that gives us that measurement, the calibration across many nations of a global economy, at best running at, let's say, 3% GDP. I can't believe I'm saying that. Thanos Vamvakaitis is global head of G10 FX strategy at Bank of America. He brings a prodigious economics to his analysis of the FX market, including nailing euro and nailing sterling. Thanos, congratulations on the Bank of America call. I'll cut to the chase. Now what?
I think we see even further dollar strength. The forces that have supported the dollar remain very much so. The Fed is the most hawkish central bank out there, dealing with an overheating economy, and they're likely to hike much more than the other central banks. Wage pressures in the U.S., labor market imbalances are unique. We don't see the same in Europe. And most of the other economies are dealing with negative supply shocks. In the Eurozone in particular, high energy prices, the uncertainty related to the war in Ukraine, the slowing of the Chinese economy that is affecting much more Europe than the US, or in the case of Japan, where the Bank of Japan is actually happy to see the yen weakening, or in the case of the Bank of England, where they are hiking but are apologizing. Well, so all these forces are still supportive for the dollar.
Thanos, I look at the regime change maybe to come, and what's not mentioned here is the disparate feel of, say, a given Canada story and a Turkey story. I get it, they have nothing to do with each other, but what are the signals from EM and the currency pairs away from the majors?
Now, in emerging markets, what is interesting is that we have seen the strong dollar rally since a year ago, even more so in recent weeks, but the positioning in the MFX has not adjusted yet. The market is maybe slightly short EM, while in the past, whenever we had the dollar at these levels, positioning in EM was much shorter. So I think from this point of view, and this applies overall for risk assets, we have not seen the capitulation that one would have expected. And maybe what we see in the last 2 or 3 weeks is a reality check that we are in a new regime in which inflation is likely to stabilize at high levels. It is likely to drop from currently very high levels, but we do believe that inflation in advanced economies will stabilize at levels well above 2%, and central banks will keep tight policies, and most likely they will need eventually to face the dilemma: do they keep tightening to bring inflation all the way down to 2%, risking actually much higher market volatility, or are they going to blink?
Thanos, for the ECB on June 9th, they haven't even started. What you've been successful at is anticipating that actually a lot of what's going on would mean euro weakness. Others have suggested that this ECB is going to hike interest rates and they're looking for euro strength. What are they getting wrong?
I think the job of the ECB now is incredibly difficult. We do believe that they will hike starting in July by 4 times this year, but broadly this is what markets are pricing. We don't see incentive that the ECB will do more than market pricing. Next year is a question mark. The market is pricing for, maybe it will be a little bit less. But I think the overall monetary policy stance of the ECB, even after what markets are pricing, is still not tight enough, especially compared to the Fed. And the reason is that the ECB cannot actually focus just on inflation because they are dealing with many supply shocks. And they're also concerned about the periphery. The fact that 10-year BTPs now are above 3%, a critical level. This was a level in 2018 after the Italian elections. This is something that should really make the ECB concerned. So the bottom line is that the ECB cannot be as hawkish as the increase in inflation would justify because they are dealing with all these vulnerabilities. This suggests that the euro is likely to be weak.
Thanos, it's wonderful that we were talking about bond yields heading into this conversation, because there's been a strain of thought that one reason why yields in the U.S. have gone up at the speed that they have is because it has been so difficult for European and probably more Japanese buyers to really hedge out some of this uncertainty in the FX market. How much do you see it becoming more cost effective to hedge out some of this uncertainty and basically bring buyers back in a way that could be supportive in the U.S.?
This indeed, we believe, is one of the forces. FX volatility is twice as high now as earlier in the year, and hedging costs have increased. It is likely that FX volatility will remain high because data volatility will remain high, and there is still tremendous uncertainty. We're talking about government yields, and the truth is that we have no idea how fiscal policy will look like in the U.S. and in the Eurozone in the years ahead. So all these are factors that create a very uncertain and complicated outlook. And in such an environment, if you have uncertainty, market volatility, risk off, but the Fed is hawkish, this tends to be positive for the dollar. And we have seen this in dollar yen, for example, that usually risk off tends to weaken, but this has not been the case in the recent market volatility.
What's liquidity been like? We just heard from the Fed talking about the concerns about market liquidity drying up. We have seen such massive swings in FX markets that are not used to this over the past couple of decades. How much is it easy to find a deep market in the deepest markets of the world?
Actually, we have looked at this issue, and there is no problem with FX liquidity. Volatility has increased, but from very low levels. I think the Fed is trying to find an excuse to blink without blinking. They are concerned about recent market volatility, so they're trying to say that although they will focus on inflation, they will try to address any liquidity problems, but we don't see yet liquidity problems, at least in the FX market. So I don't think this is so relevant at this point. And the truth is that it is way too early for the Fed to blink. They've just started. They have to focus on inflation, and for now to ignore the fact that the market is waking to the fact that there is a new regime out there without the central bank policy pull.
Thanos, just before you run, just quickly go through your price targets. Cable 123, that's where we are now. Euro dollar 105, dollar yen in and around 130. Can you go through those three? What are you looking for?
Now, the problem we have is that we are exactly at an end-year forecast, so earlier than we're expecting. So I will say that the risk is that euro-dollar can even go to parity, cable to 120, dollar yen even 135. These are risk scenarios at this point, but if the current momentum continues, we may be at these levels in a couple of months.
Thanos, you sound like a man that's about to change your price targets. Come back soon. Thanos Mamvakidis there of Bank of America Securities. Didn't you, TK?
Brutal.
Didn't you get that feel?
Yeah.
I mean, he's been right the whole way in the FX market, but here we are.
To explain to our audience, they have rigid rules from their legal department. They cannot tell us what's coming. They can't get ahead with the media of what they publish in print to their clients.
But we got a feel for
really
it, Tom.
serious.
We just got a feel for it,
I got a
TK.
feel for it.
He's been dead on, though, Tom. When it comes to the single currency, it's just a fantastic call from Thanos and the team.
The problem is Thanos has Brian on line too.
Don't do it. Don't do it. Lisa, that dollar, that euro story more specifically, it's caught a lot of people out.
It's caught a lot of people out, especially as we talk about parity and we talk about how much the ECB can actually do. Let's say the ECB is more dovish than people expect, which is what Thanos was saying. What's the response in the euro? Does the euro actually lose that much more traction versus the dollar? Or, John, is that actually potentially supportive because it might give a greater runway to the euro region economy, given the fact that they're hiking into a supply chain-driven inflationary shock that is different than if it's really generated from demand?
The problem at the moment is that it's lose. If you back off, it's for all the wrong reasons. right? And if you lean in, a lot of people start to think about bad outcomes.
I do think right now the drivers of inflation are going to be important in terms of where the blinking happens for both the Fed and for the ECB.
Thanos said just then, this Fed's not blinking anytime soon.
That seems
That's their
to be,
view.
yeah.
1% on the S&P, on the NASDAQ, up by 1.45 from New York City. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden said Vladimir Putin believed he could break up NATO and the European Union with the war in Ukraine. He told a fundraising event that now he worries that Putin doesn't have a way out of the war. The president called the Russian leader, quote, a very calculating man. Meanwhile, President Biden will highlight his efforts to stem inflation in a speech today. It comes at a time when soaring prices threaten Democrats' slim chances of holding on to Congress after the midterm elections. The president will draw a contrast with a Republican proposal to raise taxes and let popular programs like Social Security and Medicare expire. China is tightening pandemic restrictions in Shanghai and expanding a mass testing sweep over in Beijing. More people are being shipped off to government-run isolation centers under a new definition of what it means to be a close contact. The country reported a little more than 3,400 new infections Monday. That is the lowest daily total since March 16th. And Bitcoin has rebounded after falling below that $30,000 threshold for the first time since last summer. As its lowest, the world's largest digital coin was down some 55% from its November high. Billionaire cryptocurrency investor Michael Novogratz warns that he expects things to get worse before they get better. And global banks are now pulling away from the orangutan market they helped create for blank check companies. Bloomberg's learned that Goldman Sachs is ending its involvement with most of the special purpose acquisition companies it took public. Meanwhile, Bank of America scaled back work with some SPACs. The SPAC craze has faltered in part due to the new guidelines from federal regulators. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have a perfect storm of weakening global growth in all regions. So in the US, you have this huge idiosyncratic tightening of financial conditions. In Europe, we have the war. And I think what broke the straw that broke the camel's back, so to speak, was the China COVID lockdowns.
Things get worse in China. George Saravelos there, the global head of FX research at Deutsche Bank from New York City this morning. Good morning. We have a bounce back on the S&P 500, a little bit firmer, up 0.9%. Yesterday, a break of 4K, a close below that level at 39.91 on the S&P 500. The first such break and close there going back to March 2021. Yields come in a couple of basis points to just north of 3% on a US 10-year. Crude down again, 101 on WTI. We are down by 1.6%. And a downgrade on Chinese assets from the BlackRock team, Jean Bavin and Wei Li. And what's interesting about this is it's not just about the lockdowns in China. TK, take a listen to this. This is also about Beijing's ties to Russia. Quote, foreign investors could face more pressure to avoid Chinese assets for regulatory or other reasons. I find that very interesting.
We spoke to the White House yesterday about this, about the machinery of actually doing sanctions. And not that everybody's going to go after China, but in a partial way, that could have a large effect as well. John, I would also note dollar resiliency this morning, but away from yen, away from euro. There's some other noise going on in the FX market, which maintains a resilient dollar. Right now, he has given us resilient opinion and science on this COVID pandemic. We are thrilled to bring you Amesh Adalja this morning, senior scholar, Johns Hopkins Center for Health Security. Amesh, are we getting a new bout of COVID? I look at the cases up, hospitalizations up, deaths not so much. Is there something new here we need to worry about in July or August?
Well, what we have to worry about is the fact that there are more contagious variants that are evolving. BA2 and now an offshoot of BA2. That is the most transmissible version of the virus that we've seen. And you couple that with people back to their activities, yes, you're going to see cases go up. But what you have to really keep an eye on is hospitalizations in terms of what percentage of hospital capacity are they at. And from that standpoint, I think we look good because cases are always going to go up and down. This virus is going to be with us. Our goal is to make it tamer and shift it to a milder spectrum of illness. And I think that's what we're achieving.
Can we help with an initial booster, a third shot? And dare I say that we're going to be discussing this summer a fourth shot, a second booster?
I think that we don't really have an optimal booster policy. And when it comes to the boosters, this is the original version of the vaccine. And now we're fighting a virus that's mutated several times or several different lineages away from that ancestral strain. So what we see is our vaccines are holding up really well, even in their original formulations, against what matters, serious disease, hospitalization, and death. But they're not as robust at preventing infection anymore. So I don't think that outside of high-risk populations, boosting them with the original version of the vaccine is going to do much but give a transient benefit. I think we have to think, does the vaccine need updated? What is our overall strategy? Is it to keep people out of the hospital or is it to prevent all infections? And that's how the booster strategy should be formulated. But we do need newer generation vaccines that are better than the current version with what we have now.
Dr. Adalja, we're talking about nuances here in the United States and to some extent in Europe. It is a very different picture over in China. What would happen if Xi Jinping reversed course and abandoned zero COVID from a health perspective?
It all depends upon how the population reacts. If we know that they have a low vaccination rate, especially amongst their high-risk populations, which is kind of paradoxical and backwards. So that would mean that hospitals may get inundated. So what they have to do, when they pivot off of zero COVID, they have to vaccinate their population. They have to start using all these tools like Paxlovid and monoclonal antibodies and rapid tests to be able to mitigate what's going on. And then you also have to make sure that hospitals have capacity, that they can make hospitals. And we know China can make hospitals in a week if they want to make them. They need to make sure that they have capacity to deal with it. But that is the solution, no matter how you look at it, because the virus isn't going away and China can't isolate from the world forever. And that's the only solution that you have with a rapidly spreading, efficiently transmitting virus like COVID-19.
From a health perspective, what does it do to the virus to have an entire nation that is under-vaccinated and not developing the herd immunity that other regions are? When it does reopen, is there some sort of incubation risk or some sort of mutation risk that could evolve if you do get a mass upswing in cases in a specific region, even after the rest of the world has tried to move on?
Anytime the virus can spread unchecked, there's always going to be a risk of new variants occurring. We've seen that with South African variants that have been discovered there. We've seen that even in the U.S. with variants that have been discovered here. But I think that the goal here has to be to get the population vaccinated, and we will deal with the variants as they come. We're always going to see this virus evolve. It comes from a viral family that causes 30% of our common colds. It always evolves. But we have to keep abreast of those variants and study those variants. But I think that the zero COVID policy is so bad and so disastrous that it has to be moved from. And we have best practices that could be used. They don't need to stick to this any longer.
Dr. Adalja, in May, one of the great joys of the streets of New York is to see newly minted graduates and undergraduates walking around in their robes. Yesterday, 6 or 7 newly minted MDs from Mount Sinai walked by me. What are they walking into in hospitals? Are they walking into staffed hospitals, staff doctors, staff nursing with a new attitude post this pandemic? Or are they walking into hospitals basically in chaos?
The hospitals are not in chaos. I worked at the hospital just last week, and I'll be there this weekend. They're not in chaos. I think we're in a much better place. I see very few COVID-19 patients in the hospital now. Hospitalizations are up, but they're nowhere near what it was like during the Omicron surge, and definitely not during the December 2020, January 2021 kind of tyranny that we had in the hospital with COVID. So it isn't something that's completely disrupted. We do still have staffing issues with nursing, particularly because that nursing market has changed a lot with travel nursing and nursing being able to bid up the prices. So hospitals are trying to adjust to that, but it's not anything like what we saw in the past. It's not chaotic. I think the hospitals are in good shape. Although we do now have shortages because of the Shanghai lockdown, that certain IV contrast dyes for CAT scans are not available because of what's happening in China and their zero COVID policy.
Doctor, thank you, as always, for your hard work. Dr. Amish Adalja there of the Johns Hopkins Center for Health Security. Lisa, I think you're trying to get to the right issue with China. What do we face here? Perpetual lockdowns in that country? What breaks this?
Right now, from a political standpoint, it seems like very little because they're just cracking down harder in terms of trying to keep some of the information within China, as well as, frankly, isolating people who've had any contact. They call the people who are tasked with enforcing this the big white, basically these people dressed in gowns that go around and try to identify anybody who's had contact with anybody else. How do we get out of this? And if we don't, what is the consequence to an economy that's already struggling with supply chains and already struggling with shortages of goods?
Or supply chains, TK. Let's talk about it. You heard Dr. Adalja there, struggling to access certain supplies. That's the healthcare industry. I'd say that extends worldwide, doesn't it?
It extends worldwide with food heating up in a passion. John, on China, I would suggest the China pros I talked to put all of their focus on November in the Party Congress.
And that, Tom, is later this year, in the fall. So maybe no change until then?
No, I'm not saying that. I'm saying that there's a date, there's a calendar date for Mr. Xi to focus on.
Futures up 0.8 on the S&P. Yields down just a single basis point, 3.02%. From New York up next, David Stubbs of JP Morgan. This is Bloomberg Surveillance.
You have all of the three world's biggest economies suffering from these shocks at the same time.
We also run the risk of a second repricing lower if we see demand destruction roll back.
We could see prices peak back up as we move into the third quarter, really complicating the picture for the Fed.
I just wonder in July whether the Fed will have the stomach, after three good inflation reports as well, to do another 50.
The story here is pretty clear. The Fed's been way behind the curve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This market needs a therapist. From New York City. Good morning, good morning. For our audience worldwide, live on TV and radio, alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures up 0.8%. TK, there's your bounce. Will it stick?
Well, there's the bounce, and there's the bounce this morning with a little bit of hope and prayer. As we mentioned the last hour, John, maybe it's a shift on the Fed guessing game and such. But as Lisa mentioned, earnings, you know what? They're better than good, and strategists reframe, they readjust.
And we look forward, Tom, to CPI tomorrow. That is the major one, the big one for this market.
I agree, and it's going to be interesting to see. Let me get that up here, John. I know you already know the numbers. I don't. Year over year. John, I'm still not used to an 8-figure. I mean, I don't know what else to say.
We're looking for another one tomorrow. Wall Street will look for one thing, and the front covers of the newspapers will go with something else.
Yeah.
Lisa, the front pages, and I would argue this administration too, will look for that deceleration in the headline number year over year. Wall Street will be looking at core month on month. It's going to be a different story.
And they're also going to be looking at the components. What's driving the deceleration in inflation and what's driving ongoing inflation? I'm wondering how much of the new surge is due to the supply chain disruptions and whether that changes the story for a Federal Reserve that is trying to fight demand side inflation, cannot do much about the supply side unless they just simply crimp how much growth there is in the economy.
Is it enough to change the tone of what's happening right now? A mechanical peak in CPI year over year.
I really do go back to the components. If you start getting a mechanical peak, but you see real momentum in wages, you see real momentum in rents, how can they justify not hiking quickly into that? How can they really change some of their tone? And also, if we don't get a significant deceleration over the next few months, does that really change anything if you have inflation running at 7% rather than 8%?
Ton of Fed speak coming up. Bramo's going to run through it. Equity futures right now, a little bit of a bounce, up 0.8% on the S&P. Some real pain in the Nasdaq 100 over the last few days. You've all seen it. The Nasdaq now up by 1.2%. Yields yesterday actually lower and not higher, particularly at the front end, and we'll keep building on that conversation through this morning. Today on 10s down a basis point. Lisa, just about holding on to 3% on a 10-year maturity.
How much this really is the focus. Bond yields going down in tandem with equity selling off, a lot of people think is a good sign. This is traditional risk off. Does this signal some sort of shift, some sort of floor in how low things can go? Today at 9:45 a.m., Treasury Secretary Janet Yellen is testifying to the Senate. She's going to be testifying in a session called the Financial Stability Oversight Council Annual Report to Congress. How much does she strike a slightly different tone than President Biden when it comes to inflation and how long it will last? He is counting on it to roll over before the midterms. Today, we also get that slew of Fed speak, as John was mentioning. Cleveland Fed President Loretta Mester is going to be speaking with our own Michael McKee at 11 a.m. Other Fed speakers include John Williams, Tom Barkin, Neil Kashkari, Raphael Bostic, as well as Fed Governor Chris Waller. Do they give an inclination to the question that John was talking about earlier, and Tom as well? Where does the put come in? At what point do they basically say, you know what, maybe we're not going to raise rates as much as the market expects? How much does it matter what the components of inflation are when supply side inflation, a shortage of goods, is very different than people just having so much money to spend and actually deploying it? And at 11:30 a.m., we do get words from President Biden on inflation. How does he deal with gas prices that are rising to new highs, John, even though the price of gas has been coming down and the price of oil, I should say, has been coming down? How do we deal with refineries? How do we deal with investing in fossil fuels at a time when they really are trying to push a more green agenda?
I wonder if he'll talk about this market too. Lisa, thank you. Here's a stock that looks really ugly. Into today, Peloton was already down by about 60%. In the pre-market, it's down almost another 17 percentage points. And they are just saying all the wrong things right now. Revenue comes in softer than expected. The outlook's softer than expected. They're also seeing a small increase in cancellations due to a sub-price hike. TK, not what you want to see, and it's still falling.
Yeah, well, that's because my workout with Peloton is surrounded by immersive technology.
Is that their line?
That's what they have immersive technology.
The stories used to work, Tom. The stories used to work. We joke about it. They don't work anymore. Yeah, show me the money.
That's exactly right. And the money is, since the day I bought my Peloton, we enjoyed a 93% drawdown as well. What I do know, John, is David Stubbs is so cut and chiseled. He's on the Peloton about 6 hours a day.
He joins us now. David Stubbs, the Global Head of Cross-Asset Thematic Strategy at JP Morgan Private Bank. David, we won't talk to you about your workout regime. We'll talk to you about this market. David, it's been brutal. I want your thoughts on what's happened and how you're allocating capital right now.
Well, John, it has been brutal for both equity and debt. I think that what we've seen is the creation of quite significant value in the fixed income space. We're now starting to move some of our cash, some of our very short duration fixed income out the curve. Yes, your bond yields could go higher from here, but we think now we have a kind of asymmetric return profile in a lot of the government bonds around the world. Yes, you could lose a few percent if we see another 50, 100 basis points up from here. But if we do see a growth scare or indeed a recession next year and into 24, you'll get a double-digit return on those government bonds. So we are calling now for adding to a little bit of duration there in portfolios. On the equity side, I think what we are seeing now is a bit of a morph here from the fears of what the central banks are going to do to the fear of the growth slowdown. And we've actually seen earnings, as you said earlier, be pretty stellar. They've been actually upgraded. 2022 earnings have been upgraded around 2% in the last few months. Obviously, the big question for next year is, can they hold in? The more we see that growth slow down, the more those earnings estimates have to fall.
David, wonderful to have you in our studios. I want to go to a JP Morgan timeline of, say, 3 years of short term versus a Robinhood timeline, which is where the market was 8 months ago. You did one of our interviews of the year last year on technology and what we don't see out there. One of the things we don't see, you say, is the seeds of disinflation. Sure. Discuss that.
Yeah, absolutely, Tom. I think that we are on the cusp of a multi-year upgrade cycle across corporate America and indeed the corporate sector across the developed world, where a whole range of new technologies are going to come in, start to augment and replace labor when you have tight labor markets. And I think that is going to lead to another round of disinflation as we move through this this cycle, and a new round of productivity as well. And that's very exciting. But here's the problem. That takes a while. And it takes a while to invest, takes a while to integrate these systems, and we've had such a persistent cost push, inflation issue for the corporations. Mm-hmm. In the short term, last few quarters they've done with it well. Earnings have been stellar. In a few years from now, I'm sure that these new improvements will be bedding in. Between now and then, unfortunately, I think we've got a few quarters of margin compression. That's what the equity market is worrying about. But I think it also opens up the possibility that we are seeing an entry point for certain categories of technology, certain providers of these new technologies, which is going to set us up for excellent returns in the next few years.
And critical, as alluded to in Mr. Diamond's annual letter, this is not a pandemic one-off. This is not about the pandemic and technology getting ahead of itself because it had to. You're looking at this as a much more persistent and structural industrial shift.
Yeah, I think those are two very different things, as you say. Yes, there was a huge amount of investment brought forward to deal with the pandemic. If you look at tech, physical tech spending in terms of investments in the GDP reports across the world, they're very, very strong. They could actually be quite soft in the next couple of quarters, maybe, because of that bounce was brought forward. But what we're talking about here is actually moving into a new regime of tighter labor markets, of shorter supply chains, of a desire to make things closer to home, and the need to do so at a cost-effective price will force people to adopt elements of automation, not just in manufacturing, but also in the service sectors as well.
David, aside from specific pockets of tech, on a broader level, are you prepared to say that we have seen the bulk of selling and that actually it's a good time to add risk more broadly, not just duration?
I think if you look at the sentiment in markets, is obviously incredibly bearish right now. We had some numbers that we calculated on this. When you assess sentiment broadly across, say, volatility, pricing, etc., if you buy at these levels, you usually get about a 6% return over the next 3 months versus 3% at another time. So a tradable rally, is it likely in the next few months? Sure it is. And you just need a catalyst for that. A soft CPI print tomorrow could absolutely be one of those catalysts. A hot one, I think, would be pretty tough for the market to take. Broadly, though, Lisa, I do think we're in a period of more volatility than return, because we have to get past not only the tightening of central banks, but then the impact on growth the other side. Hopefully that impact is modest, inflation eases, and you have this fabled soft landing, in which case there's not much further downside from here. The scary part, of course, is that if growth slows significantly, inflation is a little bit more sticky, then the growth next year is going to be very meager indeed, and fears of recession will, of course, pressure risk assets.
That's the problem right now. What do we get? David Stubbs at JP Morgan Private Bank. David, always great to catch up with you, buddy. Just to return to that Peloton story, we're down by 17.5% to 1165. We've already taken out the pandemic gains for this stock. And this line from the CEO, Lisa, talk about a company caught wrong-footed. The balance sheet challenge has been managing inventory. We have too much for the current run rate of the business, and that inventory has consumed an enormous amount of cash. What a change in fortunes for this company in 2 years.
Is it an outlier, or is it one of the examples of how much ebullience there was during the pandemic? It is shocking to see how much of a reversal, and people were talking about some sort of Sex and the City issues they had with some of their advertising. Remember when they had that episode with Sex and the City with Chris Noth, and he died on a Peloton, and it became a sort of PR crisis? They've got a lot bigger problems. That was my point. Thank you. That was my point, was that they've got bigger problems than that. John.
This line, Tom, I think is going to stand out for you. I'll say it, don't worry.
He's going to move on.
The CEO, Tom, thinly capitalized for a business of our scale. Now, to Lisa's point, is this a Peloton story, or are there other Pelotons out there?
In their defense, in the old days, they would have been a private company. Maybe they never would have gone public in the derby that we have today. John, $3-4 billion of total revenue. The EBITDA margin is non-existent to negative. Is this a really publicly traded company with a persistent cash flow? Maybe not. What I know, John, is I do get, when I'm on my Peloton, I get exhilarating motivation.
Do you?
That carries over to the mornings.
I do.
Would you allocate any of your cash to this particular stock this morning, Tom?
Yeah, I
Stay
get
triple leverage or cash up.
Fill my tang here, please.
Yeah, okay.
I need exhilarating
Peloton
motivation.
down 17.5% in the pre-market. Equity futures up. You've got a bounce up 0.7% from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will highlight his efforts to stem inflation in a speech today. It comes at a time when soaring prices threaten Democrats' slim chances of holding on to Congress after midterm elections. The president will draw a contrast with a Republican proposal to raise taxes and let popular programs like Social Security and Medicare expire. And just in time for summer driving season, U.S. retail gasoline and diesel prices have set a record. According to AAA, average gasoline prices have hit $4.37 a gallon, whilst diesel is at $5.50. Americans are expected to drive more this summer than in 2021, despite the pricier gas. President Biden has signed into law a measure designed to make it easier for the U.S. to send weapons and supplies to Ukraine. The legislation cuts red tape but does not include additional funding. The president has asked Congress for $33 billion in aid to the Ukrainians. And those shares of Peloton are falling in pre-market trade. The fitness company reported fiscal third quarter revenue that missed estimates, and its outlook for fourth quarter revenue was well below expectations. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You heard my president several times, and he said the need should be to have these negotiations on the highest level. My president is ready for these negotiations. Unfortunately, once again, we see no readiness from President Putin himself to be a part of these negotiations.
Always enjoy hearing Maria Tadeo catch up with Ihor Zovka, the advisor to the Ukrainian president from New York City this morning. Good morning. Equity futures positive 0.6%. We faded a little bit here, just a little bit, still positive on the Nasdaq at 1 full percentage point. Here's a stock that's been absolutely crushed year to date and on the session as well in the pre-market. Peloton down 16.8% and just saying all the wrong things right now. A miss on earnings, a miss on revenue to be specific, a miss on the guide as well. And going forward, this is what they've got to say. The inventory's eating up cash. It's leaving the company, quote, thinly capitalized. That stock, Tom, really struggling.
It's really struggling as well. And, we're going to get more stories like this, John. It's just where plans blow up, and they blow up in different ways. This is, John, can we say that Peloton is old news right now? Like, it's not that we didn't know the specifics here, but
no, there's nothing new about this,
ugly.
Tom. There's nothing new about this, but I do think it's interesting. You've got a company that's seeing great demand, so they build up inventory. They build up inventory. They build up inventory. And here we are, demand's gone. Just nothing like what it was. And if you see the pandemic story, if you took a 5-year chart of the stock, Tom, great story. The likes of Cathie Wood and others who like these kind of names, fantastic. Then all of a sudden, big fade. That's what we're dealing with. And when Lisa's talking about the prospect of how many Pelotons are out there, that's the kind of dynamic we're trying to think about going forward from here.
Including the two in her living room. Right now joining us, Joe Matthew in Washington and Maria Tadeo in Brussels. I hope I pronounced Brussels okay there. And we look to Maria Tadeo now for a morning brief. Maria, I was shocked at the research notes from international relations and also from those more Wall Streety on the speech of Mr. Putin and his fragility. How is his health discussed in Brussels?
Oh, Tom, you have to be very, very careful about that because we know that there isn't a lot of information. The Russians, of course, that is completely a no-go. The image of Vladimir Putin in his native country is, of course, the man who is, well, a military genius, but also in very good health. We don't know anything about his private life, and he simply won't go there. When you look at the European institutions, I think they want to be incredibly careful because after Vladimir Putin, it's not clear what would happen to Russia. And of course, the big thing the Europeans want to avoid is not repeating that mistake of President Biden almost suggesting that there should be someone after Vladimir Putin and that there should be a regime change. So that's why I think they're very careful about his health.
Maria, what are the next steps for the European Union with respect to this oil ban that we still don't really have details on?
Look, I think this is another big mess for Europe. I think once again it's the same old story. The politics, the energy, security, defense are all very connected. And today you have the former German defense minister, Ursula von der Leyen, who now leads the commission on a plane to see Viktor Orban to try to convince him that he should approve this embargo. So again, it's a very tricky situation where the politics, the internal dynamics of the European Union prevent quick action. And really, there's a growing debate here in Europe as to whether or not this principle of unanimity should be dropped. The 27 countries, remember, they have to agree. Nothing is agreed until everything is agreed. That's how Brussels work. But increasingly, there's voices that suggest we have to ditch it. We're way too slow.
Joe, we're about 4 hours away from President Biden's speech, where he's going to try to come up with some sort of new narrative to paint around the inflation that we're seeing here in the United States. What has stuck so far that he has tried?
Well, that's a good question, and you'll have an opportunity to pick through some of the things that the administration has tried. But if you look around, I don't think it's well, look, it's pretty obvious that as many swings as the administration has taken here, it has not really made contact with the ball. They like to talk about the Putin price hike, but of course, energy prices were soaring even before the war began. Inflation was an issue before we ever started talking about Ukraine. So today he's going to talk about attempts that have been made, and he's going to suggest that, or in fact, urge Congress to pass a lot of ideas that have never been able to pass before. Build back better. Think extended child tax credit, lowering the cost of prescription drugs. There's going to be a familiar sound to some of the ideas that he's urging Congress to act on. But there's a reason why they didn't pass last year in a midterm election year, Tom. It doesn't look like they have a great potential to move now either.
Joe, swing it back to the foreign front of Mr. Biden. And the bottom line is he needs help from Brussels. How allied, Joe Matthew, are the allies right now? How is that perceived in Washington?
Well, you're going to see an example of that today with Mario Draghi visiting the White House, and that's going to be, a united front. They may not agree on everything here. Italy has a much different relationship with Russia than the U.S. did going into this war, but that's going to be an important optical presentation here for the White House. But the president is still asking for money. You know, it was some days ago he asked for $33 billion, and this latest tranche of war funding for Ukraine has been bogged down in a conversation over COVID response funding. Now, at this point, it looks like they're going to break them apart. President Biden last night gave it the okay. He said, look, I realize that we don't have the votes here. Strip it and let's pass that military and humanitarian aid as a clean bill. As we understand right now, according to the Pentagon, the administration will run out of its authorized drawdown money in 9 days. So they need to get this on now.
Joe, thank you. Good to catch up. Tom, would you like to thank Maria?
Oh, Maria, thank you.
Thank you, Maria.
So, Maria today.
I'm scared to say Maria's second name now, just in case she jumps out the screen.
You got it right.
Thanks, Maria. We appreciate it. Sandon coming up a little bit later.
And
Javier
Javier Blas as well.
Weekdays. Is he joining Joe
No,
Matthew,
that was
Tom?
terrible, Tom. That was terrible. That was terrible. Just don't.
Just don't.
That
Just
needs
don't.
a lot of practice.
Okay. Maria, I'll catch up with you later. Thank you. Sandon with Joe
Please
Matthew
do.
at 5 p.m. with Maria
We're
and
going to go to
Javier
Carolyn Conan
joining
in
him.
Paris as well.
They're going to have some fun TK.
John,
a little bit
seriously,
later. Sure.
Italy, Germany, to the moon. I mean, Mr. Draghi joins the White House, and you've been world class on this. I mean, Italy to Germany 10-year goes from a 1 percentage point differential, doubles out to 2 percentage points. I mean, that's a reality Mr. Draghi faces.
Yeah, 200 basis point plus spread over the last week or so, Tom.
Are you
June 9th,
okay
the
on
ECB
that?
meeting. That was great.
Good.
That's the market. Let's talk about the politics. And you touched on something important. Italy's relationship with Russia has been very different than the United States, America's relationship with Russia. It's worth remembering that only a number of months ago, when we had a massive Russian troop buildup on the border of Ukraine, and many people were accusing the Russians of preparing to go in, to invade the country, and the Russians were denying that the Italian business leaders were looking for a meeting with Vladimir Putin, Tom, to talk business. That's how much things have changed in just a few short months. And there is a fear, I think, still, Tom, that maybe they will snap back, that perhaps they still could. Now, I know that's not the consensus view, but still that fear exists.
Right. Well, I think, John, it needs reporting from Rome. A surveillance road trip there to
Another tour.
meet with Mr. Draghi.
Will you practice your pronunciation of Italian names?
No, I got to get through the Spanish names first.
Still scarred from Maria in the last 24 hours.
Just
and this morning too. Just don't. Just don't. Futures up 0.5% on the S&P from New York. Heard on radio, seen on TV. This is Bloomberg Surveillance. Coming off the back of a 3-day losing streak on the S&P, we have got a little bit of a bounce. Equity futures up 0.6% on the S&P 500. On the Nasdaq, up by 1 full percentage point. The Nasdaq year-to-date battered, bruised. We've talked a lot about big tech, small tech, all of the above. Let's talk about energy. Yesterday, down more than 8 full percentage points. That industry group on the S&P 500 lower, much lower. Commodities down too. And an interesting move at the front end of the yield curve that we need to keep talking about. Switch up the board and get to the bond market. Twos, 257.75. Last Wednesday, 285. Yields lower yesterday. Yields lower again today by a basis point. 257.75. 10's a break of 3% now. 299.87. This starts to get interesting. It's not just about equities down and bonds down, yields up. We're going the other way on yields. And I would say look to break-evens too. Break-evens starting to go the other way as well. Now, Lisa, you know the calculation behind this. You take the yield of the inflation-linked curve, you subtract that from the closest nominal maturity, you take those yields, put it all together, that yield, the implied inflation rate, and that's coming back in. So that's inflation expectations, a market-based rate for it. And Lisa, we're going the other way. Growth down, inflation down, a growth scare in yesterday's price action.
And perhaps the Fed won't be able to go as much as people previously expected. And that's what we're seeing kind of baked into a market that's increasingly concerned. How much is this because, frankly, the inflation that we're seeing is coming from supply chain disruptions, which is not long-term inflationary. That is more stagflationary, that is more concerning for growth, and that really underpins some of the moves that we've seen.
Tom, this is not a judgment about the future, just an observation about what's happened over the last 24 hours. But it's notable, TK, that this is going the other way.
The bonds are in a jumble. We're going to get to Kathy Jones here in a moment, John. And I also note the foreign exchange market in a jumble. We've got two reports just in the last 10 minutes. Abraham Rabari at Citigroup reframed strong dollar. And he also says yen quiescent until a 135 week yen level. And Ben Emmons right behind him saying, no, not a 135, ever weaker, 145. That's a scope and scale, John. And where is that scope and scale in the bond market? We don't have an equivalent view in the bond market like strategists are guessing in foreign exchange.
Looking forward to catching up with Kathy, Tom, in just a moment. That's the cross-asset price action. Let's get you some single names, some stock movers in the pre-market. Let's get to Romain. Good morning, Romain.
Hey, good morning, John. Yeah, the growth story, really the macro story driving the equity action, but raising a lot of questions now as to whether people are overlooking the micro. Apple sort of emblematic out that, down 16% now from that all-time high. A company with $95 billion in free cash flow, $100 billion in net income, GAAP net income to be sure, and a PE ratio that's smaller than more than half the members of the NASDAQ 100. Now near oversold conditions. You're seeing a bid come back into this market today, only up about 1% after slipping more than 8% over the past 3 days. It'll be interesting to see whether some of these sort of stalwarts of the market can sort of reassert themselves, whether there's enough confidence out there. Do you put Apple in the same basket as Upstart Holdings? Upstart down 52% right now. Of course, this is the lending platform, basically saying it's going to have trouble meeting its guidance for the year. It missed pretty much across the board on the main metrics for the quarter. Higher interest rates, and you talk about the fact that loan growth, loan balances are rising. That's creating a risk spectrum here that some investors don't want to be a part of. Upstart Holdings slide, dragging down other peers, including a firm down about 14%. SoFi also lower here in the pre-market. You talk about some of the pandemic darlings, GoodRx, remember them? They're pulling their guidance for the year, saying they're not going to meet the targets, just flat out saying that, not providing anything new. Those shares down 41% here in the pre-market. The company also said that some deal that it had with the unnamed grocery store chain is basically affecting its earnings, some shift there in how that company recognizes PBMs that GoodRx works with. And of course, you guys have been talking about Peloton all morning. Those shares now down almost 25% here. And I'm not going to rehash the numbers, but I do want to point out, guys, the inventory numbers on this are just absolutely astonishing. You go back to June of 2020, you had inventory of something like 200 million on the balance sheet. By June of 2021, that had swelled to 900 million. And now, as of the March quarter, you're at $1.4 billion in inventory on the balance sheet. And the company says, don't worry, we'll sell all that. This is more of a cash flow timing issue rather than a structural issue. Investors not buying it, Tom.
Yeah, the cash conversion cycle doesn't exist. Roy Bostic, thank you so much. Greatly appreciate that. The close this afternoon. Right now, Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. Kathy, a given bond ETF is down 16% in price, 9% annualized, big loss. I would suggest the bond market handles price decline in a bond bear market differently than the equity market. What are you observing from Schwab clients as they enjoy price decline?
Well, I'm not sure they're enjoying price decline in bond funds, but what we are seeing is investors trying to take on a little more income by going into longer duration bonds. And this has been our call recently to start gradually, not all at once, but gradually adding some duration as yields go up, because you have the opportunity now to get some relatively attractive coupons at prices that are often below par. So that means not only the opportunity to earn more income in a portfolio, but also potential capital gains.
Where is the biggest opportunity right now, Kathy, when you talk about those coupons? Is it in credit, and the riskier the better, or is it in full faith and credit U.S. Treasuries?
Well, I would slice it a little bit more carefully than that. There are two areas that we really like. One is municipal bonds. You can get on a tax equivalent basis for a very high income earner, north of 5% in municipal bonds, high quality municipal bonds. We're okay with investment grade, but we want to stay a little more careful because we do think we're going into, or we are in part of the credit cycle where we'll see some further spread widening. We're not crazy about the high yield simply because this is the part of the cycle where high yield usually does most poorly. People forget that it's not the beginning of the rate hike cycle. It's usually the end of the rate hike cycle when the economy's starting to weaken that you start to see those high yield spreads really move out.
Kathy, I want to focus on that for a minute because we saw a pretty big move in spreads yesterday in the high yield sector, which is something new. We really hadn't been seeing credit respond in the same kind of way that stocks had been responding. And yet suddenly we do see some sort of indication here. Is this just the beginning of a widening of a protracted sell-off in credit? Or is this basically some sort of mini capitulation that will be viable for a lot of investors?
I think it's the former and not the latter. So I think that we have seen, say, triple C's really underperform for quite a while relative to, say, the higher end of the high yield market. But as we get into higher rates, you're starting to see the impact on cash flow for those weaker companies with weaker balance sheets, maybe not as great at cash flow. It's one reason we don't like loans as well now, simply because we're starting to see the effect of the interest rate increases, and that's probably going to erode the ability to meet those obligations at the weaker credit. So definitely would not be chasing high yield at this stage of the game.
Kathy, there's a religion in the equity market that if you go down correction, bear market, or worse, at some point you grow your way back to where you were, the market high. And there's long spans where this has been a challenge. How do you do that in the bond market? If I'm X% down from the summer of 2020, how do I grow myself back with yield if I don't have attendant growth underneath it like I have in stocks?
Well, it depends. If you're holding individual bonds and you hold them to par, you're still going to get your principal and your interest payments barring a default all the way along. So you've earned whatever that current yield was when you bought the bond. If you're in a bond fund, it usually takes longer, but usually what will happen in a bond fund is the manager is reinvesting for higher income and on a total return basis over time, assuming that rates don't go sky high from here, which we don't think is likely, you earn your way back with the income component.
And Kathy, thank you for being with us this morning. Kathy Jones there of the Schwab Center for Financial Research. Citi just published, Andrew Hollenhorst and the team. Just want to read through this. Have we reached peak inflation? Peak hawkishness. Citi go on to say this. The equity market sell-off, the peak in headline inflation, and Fed officials pushing back against 75 basis point hikes raise questions about whether we have reached peak hawkishness. They go on to say, to the contrary, we see inflation reaching more of a plateau than a peak and see the potential for the Fed to take another hawkish step. They conclude, Tom, by saying, guiding to a higher terminal rate at an upcoming meeting. That's a Citi view out there this morning, Tom.
That's the x-axis on inflation. And I go back to, I think it was Ellen Zentner at Morgan Stanley, trying to define transitory as 1 quarter, 2 quarters. John, we are out is a consensus opinion 3 and 4 quarters, and Hollenhurst shoves that x-axis out. I mean, what do you do if you come down to 4%? Is that acceptable? The
4%
no.
went, Tom. 4% went, to your point.
Exactly.
We pushed this out just a little bit further, Lisa, and for that reason, does the Fed have to go further too?
And if the Fed does go further, to Kathy's point, what does that do to corporate debt? What does that do to the trillions of dollars of debt that's been borrowed, both from a governmental as well as corporate level from when the pandemic started? I just am grappling. Remember we were talking about how the Fed couldn't raise rates that far because of all of the debt that's been incurred in each successive cycle?
Yeah.
Well, What's going to happen now? I mean, honestly, now that we're talking about inflation at such a high level, this is what people are wrestling with. It's unprecedented.
Right. You know, John, I was not rude there with Kathy Jones like I was with Maria Tadeo, but bond people rationalize bear markets differently. On a given broad bond ETF, I need to make 5.9% coupon per year, John, to get back to the highs of the summer of 2020. Where am I going to find a 6% total return in bonds right now?
Especially with this inflation outlook from the Fed. Tom, here's a goal for you. New York Fed President Williams saying right now they see inflation easing closer to 2%, the Fed's goal, in 2024.
There it is. That's a Jan Hatzius view, folks.
Got to wait a whole lot longer to see that too. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures with a bounce, just about, of 0.7% on the S&P on TV and radio. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Sanctions and Russia oil will be high on the agenda today when Italy's Prime Minister Mario Draghi meets with President Biden at the White House. Draghi resolutely backs sanctions despite his country's reliance on Russian energy. He's also backed sending heavy weapons to Ukraine, even though large parts of his ruling coalition object. In Finland, the Parliament's Defence Committee has concluded that the country should join NATO. Finland started on the path to joining the alliance after its neighbour Russia invaded Ukraine. 3 out of 4 Finns now support joining NATO. That's up from just 1 in 5 before the war in Ukraine. And in the Philippines, Ferdinand Marcos Jr. has brought his family back to power 36 years after his dictator father led the country. With almost all of the returns in the presidential race counted, Marcos won about 59% of the vote. His running mate is Sara Duterte, the daughter of outgoing President Rodrigo Duterte. And China is tightening pandemic restrictions in Shanghai and expanding a mass testing sweep in Beijing. More people are being shipped off to government-run isolation centers under a new definition of what it means to be a close contact. The country reported a little more than 3,400 new infections Monday. That is the lowest daily total since March the 16th. In a big transaction in the drug industry, Pfizer has agreed to buy Biohaven Pharmaceutical for $11.6 billion in cash to gain an approved treatment for migraine headaches. Meanwhile, Biohaven shareholders will get 1/2 of a share of new Biohaven, a new company that will retain some compounds in development. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The reality is that when you think about what Russia is doing in Ukraine, it is a key contributor to some of the price increases that we're seeing both in energy and in food. Today, Russian ships are blocking the ability of food to get out of Ukraine. Because of Russia's actions, you've seen energy prices rise because of the geopolitical uncertainty. So what we're trying to do with our sanctions is to end that invasion as quickly as possible.
Wally Adeyemo there, the US Deputy Treasury Secretary, the President speaking later on this morning, 11:30 Eastern Time. Looking forward to that. Futures with a bounce, up 0.7 on the S&P, on the Nasdaq 100, up by 1.2%. Yields lower again by 4 basis points to 299.67. It's a break of 3%, Tom, on a 10-year.
It is, no question about it. Here is a quote of the day, John, as we go to Javier Blas on oil with an acclaimed essay yesterday that went viral worldwide to global Wall Street. His comment, the traditional relationship between crude and refined products is broken. Diesel oil, truck oil, has fallen to a 30-year low. Oil distillation capacity has fallen, the largest decline in 30 years. And then this morning on Bloomberg, reported by Javier and his team from Abdul Aziz bin Salman of Saudi Arabia. I am a dinosaur, but I have never seen these things. Javier, you center on a broken refinery mechanism, a broken refinery process. How does that get fixed?
It's very, very difficult. At the moment, it seems that we have hit
the refinery world right now. We don't have enough refining capacity that we can use. There is still refining capacity, but it seems outside our reach. There is a lot of refining capacity in China. So we probably need Beijing to relax export controls of fuels so some of the refining capacity of China can be used. But otherwise, I'm afraid that prices are going to have to work their way into reducing demand, and for that is a lot of economic pain.
Where is the demand destruction pivot point on Brent of the many experts you speak to?
I think that actually, let's not focus on Brent. I think that we can focus on the cost of refined products, because now the gap between Brent and where refined products are trading is so large that is refined products. In refined products, we are already there. We are seeing demand destruction in many parts of emerging markets. And it's also a question of the dollar. The dollar is very strong against a number of emerging markets currencies. And we are beginning to see demand destructions in Africa. In Nigeria, the airlines are threatening to ground all the flights because they simply cannot afford jet fuel anymore.
Javier, we're looking right now at record high gas prices in the United States. How much further do they have to go based on the people you speak with, given this issue with refined goods, not just simply the price of oil?
As you say, exactly, record gasoline prices at retail level today in the United States. Also, let's not forget record prices for diesel also at the retail level. I think that we are beginning to hit the demand destruction level also in the United States. But the problem is we are getting into the summer season, the driving season. We are after 2 years of COVID. Everyone wants to get out, wants to enjoy the countryside, explore, see family. So I think that we carry on for a few more months, and then the demand destruction really hits in September, when probably also we see a lot of slower economic activity.
In about 4 hours, a little bit less, we're going to hear from President Biden talking about inflation. Is there anything that this administration could do to actually add refining capacity, to actually accelerate some of the manufacturing so that we actually can have a supply side response to these high prices?
The administration can help certainly with the supply response for oil production, but that's also going to take time. It takes at least 6 months from any response to happen. On the refining side, very little that it can be done on the short term.
Javier, when they talk about price gouging, what do you make of that?
Oh, I mean, that is the typical thing that politicians, both in the United States and in Europe, say when they don't have any options and they need to blame someone. There is no price gouging. I mean, 1 or 2 petrol stations or gas stations are taking advantage of this, for sure. But is really what is driving the market? No way. It's just a simple excuse.
Javier Blas, thank you, sir, of Bloomberg Opinion. Did we get that right, Tom? I think we did.
You're going to ask him whether you got that right?
Maria's going to write in. I know, Javier's never complained.
No, he hasn't.
It's Maria I worry about.
Yeah, but he did try to correct us.
Did he?
Yeah. No, just to explain what it was. Javier Blas.
Okay.
Javier Blas.
We're going to keep practicing Spanish into the summer here on Bloomberg Surveillance.
For a road trip, Tom.
Another one for TK. Futures up 0.7 on the S&P, and the Nasdaq 100 up a little more than 1 full percentage point. And Tom, will keep coming back to this conversation about crude. Crude right now, 102 on WTI. It's come down off the highs of this year. The fact of the matter is, and to Javier's point, that is not what people are paying at the pump. They're paying something else.
I got a jet fuel price here, even off the pre-pandemic moving average. It's a double, John. But you know what I'm really watching worldwide? Rice, John. Rice is the thing to watch. Thailand rice, India rice. Those are the things that are going to break the back of the food chain.
Food prices elsewhere, Lisa, problematic together with what's happening with energy. Where are we? $4.33 a gallon now on average in America?
Yeah, even higher than that, actually, as we move toward the summer months. We're not even at peak driving season yet in the United States. This gas price and the oil price goes directly to the food price and, frankly, to other inflation that we're seeing as well. How much does that contribute to the inflationary surge? I mean, food is a separate issue, but oil and gas, based on the transport, has a much more global effect. And if you don't get that coming off simply because of refining capacity, not just even oil supply and demand, how much does that exacerbate what we're already seeing?
The president, 11:30 Eastern, you've heard the political talking point about price gouging, and you heard what Javier had to say in response to it. There's the politics, and then there's just the hard reality of what's happening on the ground. These are complex issues.
The big oil companies in the Western nations reported their second biggest take-home profit ever after you strip out their operating costs in the first quarter. And they actually weren't giving much of it into investment. They were just giving it back to their shareholders. And some people might say, well, you know, this is actually bad policy, or this might go against what the president wants. But other people would say this is good economics. The prices will come down. There is a shift away from fossil fuels. Why should they invest? What is their bang for their buck at a time when there's a lot of years until they get some sort of return on what they're investing?
Hey, look, it sounds a bit cliche, TK, but as always, the solution to high prices is often high prices.
That is absolutely correct. John, I just looked at my inflation-adjusted Saudi oil chart of some note over decades and decades, and we are just about above the second OPEC wave cusp on inflation-adjusted oil. I did not know that. Javier Blas knew that.
To fold that in,
I
though,
did not know that.
Tom, to the price action of the moment and the price action of yesterday, what was interesting about yesterday is that finally we had one of those days where we had this flush out in commodities, had this flush out of what happened with commodity equities, the energy producers on the S&P 500, and we had inflation expectations come in, not break out. That was a change, Tom. I'm not saying it's going to continue, but it was interesting to see that develop just yesterday.
It's the battle that's out there now, and John Williams leads on it with a view out to 2022 and 2023. He has a very constructive path back to some form of normal price change.
Lisa Shallot's going to join us in just a moment, the CIO of Morgan Stanley Wealth Management. Looking forward to catching up with Lisa in around about 5 minutes' time. Do not miss that. Equity futures up 0.6% on the S&P. The President of the United States speaking at 11:30 Eastern Time.
You have a perfect storm of weakening global growth.
Don't panic here as you see this sea of red.
We would incrementally be adding to duration here. I don't think this is a time you have to get hand over fist involved in the bond market.
At this point, we are looking for negative growth, but we haven't yet been convinced that we're going to see outright recession.
My beef with markets has been maybe too aggressive for the short term and not thinking enough about what might happen next year as well.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Eventful day before an inflation report, and the president, John Ferro, will report in the 11 o'clock hour this morning.
11:30 Eastern Time, Tom, trying to push back against some of the fears out there about inflation and ultimately push forward their idea they can do something about it. For this market, on the schedule this week, nothing else matters. CPI tomorrow, TK.
And what's so important here is a new pervasive view after talking with Javier Blas about how it's spreading throughout the system. John, the market reaction spreads throughout the bond market with significant price declines.
And that's what's interesting, Tom, about what we saw just yesterday. Treasury's advance yields dropped. We've talked a lot about upside risk to inflation. Yesterday, for me, much more about downside risk to growth because of what's been developing with inflation. That's a new development for this market, with energy equities struggling instead of rallying, and that yield moving lower instead of climbing.
And underscored by John Williams in comments moments ago, John Ferro, the president of the New York Fed, makes very clear he's got a 2%-ish growth rate, and this inflation, it comes down, but he's got a 3-year horizon.
He's got the wrong year on it, hasn't he, TK?
Yeah.
It's 2024. It's not 2022. It's not 23. It's 2024. And the likes of Citi think that this is going to stick with us for longer. They also believe that that rate, that end point, is going to be higher than many people believe.
Let's go narrow here. Value add with Lisa Abramowicz. Lisa, to your wheelhouse, which is credit, spoke yesterday. Away from full faith in credit, what did mere mortals in the bond market say?
They were starting to get concerned about those growth scares. You started to see people moving away from the riskier credit in a more significant way, at least based on the price action. And I got to say, Kathy Jones was spot on when she was talking about the fear right now among so many credit investors, which is that this next phase of rate hiking is going to lead to the growth scares that's going to lead to more of a problem for credit, which is often a canary for the rest of the risk complex.
And what's interesting here, the imagery of a busy day for all of us in economics, finance, investment, the international relations we're covering. John, Mr. Draghi, Mr. Biden, in some form of meetings here, and they have to focus on Mr. Putin.
I wonder who's got the harder job right now. Would Mario Draghi rather be the ECB president, TK? I think that ECB job is much
well
harder
said.
now, Tom.
Yeah.
Much harder than it was when he was there. When he was there, it was just one move, wasn't it? Let's ease. Let's get everyone on the governing council with me to do so. This time around, I've got no idea what you do in Europe faced with what you're faced with this year.
Governor Bailey with a bid on sterling. Thank you, Prince Charles. In for the Queen this morning, 123.31 on sterling. But, John, to all of the interviews we have, if we crack a 105 on euro, wow.
Not far from it. We've done that already a few times over the last week.
Data check. I'm going to look at the VIX, which is not with the markets, but still 33.48 on a VIX in a stick. John, what do you see?
Look out, 10-year yields. A break of 3% earlier this morning, just about 3% right now. Yields in 3 basis points. We broke 320 in yesterday's session and yields raced lower. That's interesting. At the front end too, same kind of move. Yields lower, not higher. TK, you've got to pay attention to that. Something's happening here in the last day or so that has not happened in the last few months. Yields aren't climbing anymore. They're coming back down. And I just want to repeat this. This is not some kind of judgment about what I think is going to happen in the future. It's just an observation about something happening now. It's notable.
It is. And, we're just going to have to see how it unfolds. And again, we're going to hinge everything here in surveillance on a study of inflation tomorrow. Lisa Shallett is with Morgan Stanley Wealth Management. She hinges everything on having a plan and then, heaven forbid, staying with the plan in times of stress. What's the plan, Lisa? And how do you have the courage to stay with it right now?
So look, I actually think as radical as the last week has been and volatile as the last week has been, there's an element of it that is somewhat predictable. And what I mean by that is that the market has finally gotten to the point where it's digested the level and the degree to which the Fed's going to be hawkish, but they hadn't yet really, fast forwarded that to what are the probabilities that the Fed can really execute a soft landing. And so we know from history, that in the post-World War II period, the Fed has tightened roughly 14 times. 11 of those episodes have resulted in a recession, and only 3 times have we pulled off a soft landing. And we are operating, this is a Fed, and Jerome Powell admitted this, that is operating against a backdrop where there's an extraordinary degree of difficulty. Not only is the macro environment complex, but the geopolitical environment is complex. And look, the Fed itself is trying to do something that they've never done before, which is simultaneously raise rates and reduce the size of the balance sheet. So to me, yesterday was very much something to be expected, that eventually we were going to get a growth scare where everyone starts worrying about the fact that we might, in fact, have a hard landing. And while we continue to be in the camp that says we don't see an imminent recession, the reality is that growth may slow much faster than folks believe. And so it's notable, to your and Jonathan's point, that finally the bond market is getting on the bandwagon, meaning starting to worry less about upward moves in inflation and potentially beginning to think about downward moves in inflation, which are, a reflection of weaker growth.
So, Lisa, 2-part question, just to be clear. It sounds like you expect 1, more downside in equity prices, but 2, the second part, if we have that downside, that sell-off, does the character, the nature of the sell-off change?
Yeah, I do think that it does, because I think, we start to get a lot more defensive. It's why bonds are finally getting a bid here. And so I think that defensive trade that unwound the long duration, stable growth stock trade that was really unwinding fiercely last week starts to get a bid. And again, it's what do I want to own if the economy is really genuinely slowing?
So you're basically saying, Lisa, big tech is a bright spot for the next couple of months.
So I want to be really careful, because I don't know that I think big tech in all caps is, but I think long duration assets actively selected are the place to be. So we have begun to add duration. We started that about 3 or 4 weeks ago, albeit it was early, and many of our clients who began to add back into bonds have not had a great 3 or 4 weeks. But we do think that trade may begin to work, and some of the higher quality growth-oriented names are certainly worth looking at today and buying, and that's what we're advising our clients to do.
Lisa, there have been some people who have talked about the unwind of certain non-profitable tech companies and others as the bursting of a bubble. And I take a look at Peloton this morning. The shares were down 92% from the peak. Even before going into today, the shares getting massacred right now in pre-market trading after they reported their earnings. Is Peloton a one-off? Or is this something that is endemic that has not fully been beaten out of the system?
And no, I think we're starting to get there. And on the stock side of things, I think we certainly have. What's interesting is among the unprofitable tech companies, the stocks may actually have led, and the credit market probably needs to catch up and really blow some of these triple C and junk spreads out even further. But from a stock perspective, you probably are starting to get to the point where there's enough blood and enough pain in the streets that these valuations start to look a little bit better. The key issue, however, is to recognize that companies are now, and investors are now looking at, cost of capital. And that means, to what extent has cost of debt gone up and to what extent has cost of equity gone up? And both have gone up in this rising, rate environment and the policy pivot.
Lisa Shallett, awesome, as always, from Morgan Stanley Wealth Management there. Lisa, thank you. Bramo, that point at the end there, equity-led and the pain in credit is still to come.
Yeah.
What do you make of that?
Well, this is something people have been saying, that basically credit has been much more immune than usual because of how much companies locked in debt for a very long time. They had solid balance sheets. So there is a prolonged pain here in the credit market that won't be seen until perhaps a year or 2 years from now when they actually have to refinance and tap that cost of capital that Lisa was talking about. You're not getting the same reaction function there. I think it is fascinating. Have we lost some of the indicative tools of how we sort of gain what's going to come next in the next part of the cycle?
That's point one. Here's point two from that conversation. We've pointed out a few times this morning about this move lower in yields yesterday, again today. It's an observation. The guests making the judgment. David Stubbs of JP Morgan saying, buy the bond move. And Lisa Shallett turning around and saying that's a reflection of the growth difficulties still to come. That's an important change. And as you get that change, if it develops even further, the nature of the sell-off in the equity market, if there is more downside potential, that changes too.
This is about your belief construct, John. They call it a setup. You have a setup is your belief of executing a trade, whether you're gloomy or optimistic doesn't matter here. But the real issue, John, is you have to have a belief system of which to invest in. That's really what's being tested here.
I think we've been tested more than once. You get comfortable with an idea, and then this market punches you in the face. About an hour later, maybe not even that. Yields lower by 3 basis points on a 10-year, just about 3%
Talk
on
about
10s.
the market.
Futures positive 0.9 of 1%. I wasn't talking about Maria. Although she'd do the same thing, I'm sure. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will highlight his efforts to stem inflation in a speech today. It comes at a time when soaring prices threaten Democrats' slim chances of holding on to Congress after midterm elections. The president will draw a contrast with a Republican proposal to raise taxes and let popular programs like Social Security and Medicare expire. Over in the UK, Prime Minister Boris Johnson is vowing to ramp up pressure on what he calls Vladimir Putin's cronies by driving dirty money out of the country. Johnson set an agenda that is also heavy on electoral priorities, including cutting waiting lists at pandemic-hit hospitals and boosting disadvantaged regions. Prince Charles outlined the agenda in Parliament, standing in for the 96-year-old Queen. She was said to have mobility issues. British Airways reportedly is overhauling its management in the wake of problems that have hurt its recovery from the pandemic. According to the Financial Times, BA has put new executives in charge of operations, technology and customer services. The airline says it's been forced to cancel 10% of its flight schedules between March and October because of staff shortages. A big transaction in the drug industry. Pfizer's agreed to buy Biohaven Pharmaceuticals for $11.6 billion in cash to gain an approved treatment for migraine headaches. Meanwhile, Biohaven shareholders will get 1/2 of a share of New Biohaven, a new company that will retain some compounds in development. And it is the most expensive American artwork ever to sell at auction. On Monday night, a silkscreen of Marilyn Monroe by Andy Warhol sold at Christie's in New York for $195 million. The winning bidder was art dealer Larry Gagosian. Dealers often buy on behalf of clients who would like to remain anonymous. Global news 24 hours a day on air on Bloomberg. Quick take, I'm Ritika Gupta. This is Bloomberg.
First thing that is on my mind is that inflation is too high, and we need to act definitively and purposefully to try to get that under control. And I think if you look at what we've done so far in the last 2 meetings, we've really started that process.
That was Raphael Bostic, the Atlanta Fed president, sitting down with Bloomberg's Mike McKee. Williams behind us today. We're going to hear from Barkin, Waller, Mester, Kashkari and Bostic all over again throughout the whole of today. You're looking forward to that, I know. Equity futures up 37 on the S&P, advancing 0.9% on the Nasdaq 100, up by 1.6. There's your bounce. Julian Emanuel of Evercore writes in, good friend of this show. Hello, Julian. He says this: I'm thinking that you, Tom and Lisa, all dressed in somber navy blue, is a sign of potential stabilization. That and the 10-year yield backing off 20 basis points in the last 24 hours.
Well done.
Thank you, Julian.
Thank you. It's a tumultuous time, to say the least, and what we're going to do, folks, is bring you the best minds we can on global Wall Street and, of course, also in the nation's capital. Right now, one of those minds is Cecilia Rouse. She is chair of the White House Council of Economic Advisors and survived EC10 at Harvard University a few years ago. Did you have the Feldstein version or the Mankiw version?
I actually had, okay, I'm dating myself, Otto Eckstein.
Oh, there you go.
There you go.
She's dating herself, and she is well preserved because she's on her Peloton. That's a side story. Dr. Rouse, Otto Eckstein would say, don't look at the headline data, parse the data. You and the president have to parse the character of the nation's inflation. What part of it is the focus of the president this morning?
Well, look, the president is focused on the whole of it because he understands that the cost of food and gas and the price of everyday items for the American family. And so he comes from a family where that would be meaningful if you had to pay more for a tank of gas. And so he's focused on all of it. Today he's going to lay out his plan for addressing price increases. Of course, as his economic advisor, I am focused on the part that is about core inflation, which is not focused on gas and food. And that tells us more about what the Federal Reserve can control as it tries to address inflation, and also the parts that are more enduring and that might be more challenging to address. So, the president is focused on the whole of it because that is the reality for American families.
The whole of it is politicians away from your remit have to come up with a plan. We prove that whip inflation now buttons don't work. What's the plan?
So from day one, this president has been focused on generating an economy where there is sustainable growth that works for all Americans. So as he likes to say, he wants to build it from the bottom up and the middle out. So that was what underlied the American Rescue Plan. It was important to get shots into arms and for households and businesses to have the resources to get through the pandemic. So now he's focused on inflation. So he understands that we need to address gas prices. Much of the gas price increases of late have become because of the war of Russia's war against Ukraine. The president, in trying to ease those prices, has released historic levels from our Strategic Petroleum Reserve in concert with other countries, so that on net to date, there have been about 240 million barrels released worldwide. In addition, he's urging gas and oil companies to increase their production domestically by using existing leases and increase their drilling so that we can get more oil on the market. But he also is focused on reducing long-term costs for families. That is through, for example, reducing prescription costs by allowing Medicare to negotiate prices, by addressing childcare costs, by addressing the cost of housing. These are policies that we know will help increase our economic growth, ensure that it's more broadly shared, and in the process reduce the cost for families. But he wants to do so in a deficit-reducing way. his budget, last year he reduced the deficit by $300 billion, on track to reduce it by $1.5 trillion this year. And he does so by increasing taxes on our very wealthiest individuals and corporations.
Cecilia, with retrospect, with hindsight being our guide, was it a mistake in March of 2021 to issue $1,400 checks to every American who qualified?
It is so hard to go back and do retrospective because it's hard to imagine the counterfactual. Mark Zandi, who has tried to do so and looking at all of the pandemic policies, has estimated that had we not acted, this goes back to CARES as well, because that was important as well, but including the American Rescue Plan, we may well have faced a double-dip recession in 2021. We would be facing elevated unemployment today, and we would not have had the economic growth that we had last year, which is going to put us on a path for more sustainable growth going forward. So the American Rescue Plan was an insurance policy. We did not know how long this pandemic was going to remain a challenge. We needed to get shots into arms so we could regain our lives.
Yeah.
So worldwide, advanced economies are dealing with inflation because that is the consequence of helping families and businesses get through the pandemic when we were facing supply chains which couldn't quite handle that sustained demand.
So, Cecilia, how much does inflation have to come down before the end of the year for this growth that we're seeing to be sustained, for that not to really curtail some of the momentum that we're seeing in households?
So what's important is that we maintain our economic activity, and we don't want the inflation to become spiraling out of control and for individuals, households to become underwater. So what we need, the Federal Reserve's mandate is price stability and full employment. You gave it your header, Jay Powell, the Chair Powell, emphasizing how the Federal Reserve is on it, and that is what they are focused on as well. The president would urge Congress to confirm his nominees so that the Federal Reserve Board has all hands on deck to fulfill their dual mandate. So that is what's going to be most important. To date, we see that inflation expectations are anchored. So we're optimistic that the Federal Reserve can do its job. Meanwhile, the president is also focused on doing what he can to ease the pain at the pump and to ensure that families can pay a reasonable price for gas. He's focused on food prices, and he's focused on addressing those costs that we know that families face every day and that are so important for them.
Cecilia Rouse, thank you. The chair of the White House Council of Economic Advisors. TK, you said it. We know what the president's focused on. Now we need to see the plan of the policies, and today could be an important step.
What I didn't get to talk to Dr. Rouse about, and she's truly one of our best folks out of Princeton, and particularly on the policy side, is, John, this is the economic realities that we hear in every interview buttressed up against the political realities. She mentioned Otto Eckstein, who he tragically lost at a very young age to cancer. I remember that when I was in high school, I think it was, or maybe a bit along from there. And it was back in a time of 5% inflation, and it was one of the reasons it brought down LBJ. This president has the same pressure at 8% inflation. What do you do without slamming the country into a recession? That's the heart of the matter.
We don't know what the counterfactual is, Tom, but we do know that there were several warnings. The former Treasury Secretary Larry Summers warned at the time when that massive bill was passed. Mohamed El-Erian came out last summer and said, wind down QE, and this Fed ignored it all, Tom.
They get a victory lap right now, particularly Professor Summers. But the issue here, John, is politically, how do you do this? I mean, the economic mumbo-jumbo only gets you so far. How do you do this politically without taking John Williams' 2% down to 1%?
Futures up about 1%. Right now, we've got a bit of a bounce, TK, for now at least, on the Nasdaq by 1.6.
Triple leverage, all cash.
Yields down by 4 basis points. Your 10-year, 299.47. On TV and radio, this is Bloomberg. This time tomorrow, we will be seconds away from a really important inflation print. That is now 24 hours away. From New York City this morning, good morning. Futures up 1% on the S&P. On the Nasdaq 100, we are positive 1.6%. Again, yields are lower by 5 basis points this time on a 10-year, Tom, to 298.49.
Yeah, it's come in as well. And the yield dynamics, to me, it's a fluttery thing, John. It's almost, every time I look at the screen, the red and green mix of the yield market is a different story. And I really don't know what that signals for today. Maybe it's like, wait for tomorrow.
The only thing I can say about the moving yield is that every time we brought a story around it, they move the other way and quickly. Yesterday morning, Tom, 320. Right now, a break of 3.
Well, let's revisit this before we go global. Domestically, John, I see an 8.1% statistic, and Lisa mentioned the core CPI 6% tomorrow. I think that's unacceptable.
The month-on-month figure is going to be interesting, Tom. People looking for that deceleration month-on-month. Tomorrow, that's not what we expect on core, at least anyway.
And the makeup of it as well. Right now, we do go global, and it's wonderful to have with us again from Citigroup, Nathan Sheets. He is Global Chief Economist at Citi and former Undersecretary of the Treasury for International Affairs with Public Service at the Federal Reserve System as well. Nathan Sheets, wonderful to have you with us. I want to go to Stanley Fischer, who you had a nodding acquaintance with MIT a few years ago, which is suddenly the U.S. central bank head is central banker to the world. How close is Jerome Powell to being central banker to the world?
You know, that's certainly true during times of stress, where when global markets are under duress and under pressure, they need dollars. And on several occasions over the last 15 years, the Fed has stepped up and provided that liquidity. But similarly, I would say in an episode like the one we're in now, where central banks are struggling with this truly extraordinary set of shocks in an inflation environment, unlike anything that we've seen in decades, that the Fed is very much setting the tone. That as the Fed shifted more hawkish, that opened the way for a lot of other central banks to be more hawkish as well.
What are the stresses? For example, I take Sing dollar back to 2006, and the answer is we have a weak Singapore dollar, which is usually a crown jewel of tiger economies. Tell us what those economies do after the easy decision to defend by raising rates.
The Fed's moving. And as the Fed moves and the U.S. economy is under pressure, but still looks better than a lot of the rest of the world, you're seeing the dollar strengthen. And there's been a debate about how much traction the Fed's getting in financial conditions. But make no mistake, it's getting traction on the dollar. And Tom, as you suggest, that has echoes throughout the rest of the world. And the U.S. stronger currency is helpful for us in fighting inflation. But the weaker currencies that are on the other side of that are inflationary in those countries and making the challenges for those central banks even more acute. And in addition, for many emerging market economies, it creates tensions in their national balance sheets given their exposures to dollars. So it does create, as you suggest, some exquisite dilemmas for these central banks, and may force them into further rate hikes at times when they don't want to hike rates.
Here in the United States, in about 24 hours, as John was mentioning, we are going to get that CPI print expected to come in at 8.1% by economists surveyed by Bloomberg, down from 8.5% in the prior read. How important is it to look at the components of what's driving this inflation? What's your projection for how we can understand the granularity of this report?
I think that looking under the hood is going to be critical. We're expecting a 0.4% month-to-month read for core, somewhat lower for headline. But when I look at underlying components, I just have a hard time being too optimistic about the inflation outlook. I think in this environment with high commodity prices, supply chain pressures, potential further disruptions as a result of what's happened in China to supply chains, that it's not a positive environment for goods prices. There's a lot of inertia in shelter and owner equivalent rents. That's not looking like a very positive picture. And then finally, for services, we've got a red hot labor market, and wages may not have risen quite as much as headline CPI. But it looks to me like pressures on services prices are likely to be pretty durable as well. So I think those components right now are just not very encouraging and tell a tale of longer-lived inflation.
So do you think, Nathan, that we've seen the peak?
You know, maybe in some arithmetic sense, yes. is this the peak for 12-month headline inflation or even 12-month core inflation? Possibly. Is it likely to be on a bit of a downward trajectory, but a very gradual downward trajectory, and one that even at the end of this year, our expectation is the measures of core prices, be they PCE or CPI, are still likely to have four handles, well above Federal Reserve targets. So maybe it is peak, but it's really more, as my colleagues have said, really more of a plateau.
Nathan, how much control does the Fed really have over this inflationary impulse if so much of it is coming, in addition to the housing, in addition to the labor market, to what we're seeing in China, to what we're seeing with the oil markets? How much control can the Fed really have?
This is the critical question. Now, Paul Volcker taught us in the 1980s that if the Fed's aggressive enough, it can move that demand curve sufficiently to tame inflation. But that is a very painful process.
Right.
And I think ultimately to get out of this without a recession, the Fed is going to need some help from the outside world. Nathan, we're going to need to see these supply chains improve and commodity prices come down.
And Nathan, the common feature of Citigroup economics, from Willem Bouter through Catherine Mann to you, is respect for the data. Do you take comfort in IMF or WTO global GDP guesses now, or is it an impossible task?
The reality here is that we as economists have this tendency to forecast immaculate landings. And why do we do this? Why do we forecast the soft landing where inflation kind of eases down, growth slows some, and we avoid recession? The reality is the other outcomes are just so messy, it's hard to figure out what they look like on paper. So we write down these soft landing scenarios, and there is a plausible path to a soft landing with some luck. But there are right now the inflation risk, the recession risk, even the stagflation risk is quite appreciable, and those kinds of forecasts don't help me sleep a whole lot better at night.
Nathan, are we at any point where we turn to a nominal analysis from a real analysis? Are things so out of whack we literally go back pre-Arthur Burns?
As inflation surges, you have to start thinking about the nominals as well as the reals. Now, to be clear, I think at the end of the day, how does the Fed get traction? And the Fed has to get traction, ironically, by thinking about the reals. And I think ultimately the question that the Fed has got to struggle with is how much are they going to have to push interest rates positive in real terms to get traction on this thing. And in their SEP from a couple of months ago, they said, well, just a little bit positive. That's not clear to me. That's not clear to me at all, that we may need a substantially positive real rate. So as the world's thinking more nominal, it's going to be critical for the Fed to think more real.
Nathan, awesome to get your view, buddy, as always. Nathan Sheets there of Citi. That's how divided things still are, Lisa, that you've got a group of individuals that think perhaps they've got to go above 2, 2.5, get restrictive. Others doubting whether they can even get to 2 based on what's happening right now.
How much do we have to depend on things, on events that really are well outside of the Fed's control? And that's what Nathan was talking about, that really factors into this belief. People who think that the Fed's not going to get that far also think that growth is going to slow down enough and you're going to see some relief in some of these inflationary components. Others say there is just too much momentum under the hood.
Got an awesome lineup for you in the next hour on Bloomberg TV. Troy Gayeski of FS Investments is going to be joining us alongside Krishna Mamani of Lafayette College. We'll get the view on big tech with Dan Ives of Wedbush as well. Talk to him about Tesla and Twitter, and Judy Bill of Keene, Anderson, Rudnick, going through some signal names too. A lot to break down, Tom. A lot to break down after the last day or so, the last few weeks for that matter.
Well, we've got to talk to people with different opinions. I'm particularly focused there on Dan Ives, on his reaffirmation of tech resiliency here. As David Stubbs said, John, if you're looking at a 3 or 5 year view, that's completely different than trying to game the Fed to July 27th.
We've been looking at the carnage year to date, not just over the last week, Lisa, down 25.7% on the NASDAQ 100. What a move.
And has this basically been capitulation? I was looking at some forecasts, including from Goldman Sachs, from Peter Oppenheimer, who said it's actually time to come in and start buying. How many other people like David Stubbs are saying maybe in the short term, but over the longer term, how much do those growth concerns continue to sort of rear their heads as we head into the end of the year?
What was interesting about David Stubbs is start buying what? And it wasn't stocks, it was bonds.
Yeah.
The 10-year down another 7 basis points right now, 297.
Which really catches my attention because people were looking for this reaction function, the traditional service of the Treasury as a haven, which has not served for the bulk of this year, John.
We'll be with you together tomorrow to go through the inflation print. Looking forward to doing that with you all. For our audience worldwide, equity futures do bounce by more than 1% on the S&P, on the NASDAQ 100, by almost 2%, up by 1.9% now. Yields are lower. They are not higher. Bonds are stronger. They're doing okay. We're down 7 basis points from 320 yesterday morning, to 296.53 right now. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Sanctions on Russian oil will be high on the agenda today when Italy's Prime Minister Mario Draghi meets with President Biden at the White House. Draghi resolutely backs sanctions despite his country's reliance on Russian energy. He's also backed sending heavy weapons to Ukraine, even though large parts of his ruling coalition object. In Finland, the Parliament's Defence Committee has concluded that the country should join NATO. Finland started on the path to joining the alliance after its neighbour Russia invaded Ukraine. 3 out of 4 Finns now support joining NATO. That is up from just 1 in 5 before the war in Ukraine. In the Philippines, Ferdinand Marcos Jr. has brought his family back to power 36 years after his dictator father fled the country. With almost all of the returns in the presidential race counted, Marcos won about 59% of the vote. His running mate is Sara Duterte, the daughter of outgoing President Rodrigo Duterte. And China is tightening pandemic restrictions in Shanghai and expanding a mass testing sweep in Beijing. Most people are being shipped off to government-run isolation centers under a new definition of what it means to be a close contact. The country reported a little more than 3,400 new infections Monday. That is the lowest daily total since March 16th. And those shares of Peloton plunging. The fitness company reported a bigger loss than expected, cut its revenue guidance, and signed a deal with JP Morgan and Chase Sachs to borrow $750 million in 5-year term debt. The results suggest Peloton's comeback effort is still a long way from taking hold. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We don't want the inflation to become spiraling out of control and for individuals, households to become underwater. So what we need, the Federal Reserve's mandate is price stability and full employment. Meanwhile, the president is also focused on doing what he can to ease the pain at the pump.
Cecilia Rouse, a chair of the White House Council of Economic Advisors, talking the line of the president towards a very important speech this morning in the 11 o'clock hour. Of course, Bloomberg will give you full coverage of that speech on radio and on television as well. Cecilia Rouse studying years ago the difference between solvency and liquidity. Here with a touch on liquidity, Kriti Gupta.
Yeah, Tom, as you talk to a lot of people on the trading desks about simply what is driving this sell-off, it's not necessarily, they're not saying it's fundamentals, or they're saying it's technicals really driven by low liquidity. And you can see that when you compare this to volatility. That really brings me to my chart of the day. Volume going back a year, and you start to see this uptrend. As volatility increases, volume does too. That's no surprise there. But compare this to what you saw in January, what you saw in March, when you did see a VIX over 30, as we see right now. Volume turnover was much higher. So that really speaks to this idea that the liquidity just isn't there. People aren't getting the bids. They aren't getting the margins that they really want for this trade. And what it's doing is it's driving this major sell-off. Today, of course, being the exception as we see a little bit of a technical bounce, Tom.
Kriti Gupta, thanks so much. Lisa Abramowicz and Tom Keene welcoming all of you on radio and television. And right now, a gentleman who bet the 48-foot Grand Banks on the Kentucky Derby and went down in flames, Barry Ritholtz, joins us, host of Masters of Business and, of course, working with his Ritholtz Ritholtz Wealth Management. Barry, the clients of Wealth Management Ritholtz walk in the room and you need to display a self-confidence. How do you form a self-confidence now that gets you, your clients, our viewers, our listeners to 2023?
Well, we cheat. We don't start discussing long-term investing and volatility and drawdowns now when we're in the midst of a pretty substantial correction. We start talking about it from day one. We let investors know and we let clients know this is a feature, not a bug of volatility. We really repeated over and over again in 2021, hey, no more than a 5% drawdown on this falling volatility is the aberration. It's unusual. High volatility is the norm. Regular 14, 15% corrections is average. 13.6% going back to 1950 is average. And so enjoy 2021, but expect more volatility in the future. And, you know, I'm fond of saying the time to read that card in the seat back is not when the engine falls off the wing at 30,000 feet, but when you're sitting on the tarmac waiting for your chance to leave JFK.
Right now we're flying on one engine. Barry, one of my great mentors, John Templeton, who was very kind to me at a young age, had a wonderful phrase in that Tennessee accent. Tom, shares are on sale. Why do we have trouble buying when Templeton sees shares on sale?
Well, it's not like we're going to the supermarket and buying milk and eggs, and when we consume them, they're gone, and we're not happy when prices are higher. The next trip to the supermarket, when we own stocks and buy more stocks, they're on sale. But keep in mind, it means that anything you've bought over the past 8 months is probably below what you paid for it. And so people have a very hard time. This is a temporal challenge. This is a time issue. People have an incredibly difficult time picturing the world 10, 20 years from now, which is what, 90% of our clients are individual investors, 10% are institutions, and even those institutions are things like foundations and endowments. So they have a really long time perspective. It's very challenging to think about 2032 or 2042 when Thursday was such a disaster. And that's the challenge for investors, to pull themselves out of the moment and project forward.
Barry, I'm glad that you talked about the time horizon. It's one thing if you've got 20 years. It's another thing if you've got 3 years or 5 years or 6 years. And I wonder, you say that it's sort of the same thing that we've always seen, that it's sort of that volatility is a feature and not a bug. Is this time, however, unique for the Fed withdrawing stimulus, actually tightening policy at the same time that central banks around the world are doing the same and moving away from unprecedented policies at a time of such economic uncertainty?
Yeah, so I wouldn't say unique, but I would say rare. The last time we saw a year where both the S&P 500 and the bond index were down double digits was 80-81, 40 years ago. So most of the traders who are out there who don't really know what a rate hiking environment is like and are totally unfamiliar with inflation, this is before most of them were born. Forget before they've been on trading desks. And so it looks like, gee, this is unique and never happened before. You go to the history books, you go to the charts and the data, and it tells you, hey, this has happened before. And it's not a coincidence that looking back to 1982, 81, that wasn't the worst time to be in equities or bonds. What's different today is all the fiscal stimulus we see coursing through the system, and the fact that we're starting from zero and reopening from a pandemic closure. Right. So some things are similar, some things are wildly, wildly disparate.
Barry Ritholtz, thank you so much. Greatly appreciate it this morning. Of course, Masters in Business will give you the self-confidence you need to move forward in this market. Lisa, what a jumble. I guess it's a day of a bounce, but you sort of got that feeling we're waiting for the next news item to fall.
Honestly, I think that what we're seeing is the bond market actually getting a floor. We're seeing that bid into bonds, particularly the longer end, at least near term, at least today, at least yesterday. I mean, this to me is the most notable action in the market. John was talking about it. We've all been talking about it this morning, that even as stocks sold off yesterday, you saw bonds move in the other direction. Are people starting to see value in duration? We've heard it from analyst after analyst,
absolutely.
But we're actually starting to see it now in the market. How much does that change the narrative to a growth one rather than a rate scare?
It will change on the economic news, and we'll have to see what that is with two wide opinions there. We need to reaffirm here, Lisa, the guys like Hollenhorst, Dudley, and all, really looking for a wide set of rate increases forward.
So I'm still thinking about what David Stubbs of JP Morgan said, that the CPI print tomorrow could really change the narrative. If it's soft, how much could that cause a re-rating in the market in terms of growth scares and the Fed not having to do as much versus it coming in hot, showing that momentum that we were hearing from Nathan Sheets of Citi and saying, actually, they're going to have to go further. And even if they stay with 50 basis point rate hikes for excuse me, I'll get my words out. It is a Tuesday. Consecutive meetings, that it's going to be a lot of meetings in a row that they're going to be doing.
We should point out that Mr. Hollenhorst, folks, works for Dr. Sheets at Citigroup. I mean, they're talking from the same hymnal, to say the least. Lisa, I want to go back to your wheelhouse, which is credit, which has become very important. I mean, Mr. Draghi is an Italian, full faith in credit. Distressed credit has seen the spread widen out as well. What's general corporate credit doing better than good corporate credit?
Well, we're continuing to see spreads widen. People are getting concerned about the growth scare that we've seen in equities as well. And that, I think, is taking a lot of people by surprise that it's actually gaining steam now.
Up we go. Crisis over. Futures up 51 again. The president in the 11 o'clock hour on Bloomberg Radio and Bloomberg Television. Good morning.